solid for the last couple of days, 17.77. John, where's the euro? Are we at a 105 yet?
We're at 106.76.
Okay.
That would have session 106.59.
If you're just waking up, there is a lot going on this morning. There's no question about that, including a complete breakdown in oil. There's no other way to put it. That's American oil, 67.69. We're going to get back to $2 a gallon gas. That'll keep Lisa's H2 in good stead. Right now, we're going to talk the talk of the moment, NVIDIA, with Angelo Zeno, senior equity analyst at CFRA, who in a brilliant note has the courage to write what everybody's thinking, which is the only way you can justify this is to extend your timeline. Angelo, you go right out to 2024 and you say, look, with a 25% growth pop, you're buying a 40 multiple stock. Why don't you extrapolate out to 2025?
Yeah, I mean, listen, I think you can. I think there's, always danger with kind of extrapolating the numbers outright. But I will say this, we are believers in kind of the entire NVIDIA story, in kind of the AI story, the fact that kind of GPUs are going to increasingly represent a bigger percentage of CapEx dollars for these cloud companies. We do think over time, over the next 3 to 5 years, the compounded annual growth rate for GPUs, and specifically that of NVIDIA, on the accelerator side of things in the cloud, can grow at an annualized pace of north of kind of 20 to 25%. And that can kind of get you to an EPS growth rate over time for NVIDIA, again, north of 20%. If you're a believer that, the top line for this company can continue to grow at a mid to high teens percentage pace.
Are there other NVIDIAs out there?
So we actually wrote a piece back in late March about kind of the biggest winners of kind of the generative AI boom within the semiconductor industry. And we kind of pointed to 4 names at that point in late March. And those 4 names were, one, of course, NVIDIA. AMD is another name, clearly a beneficiary in the GPU side of things over time as well. And then the other 2 names are more kind of network connectivity type names. And they were Marvell as well as Broadcom, a name that we think is highly underappreciated, a name that's going to report tomorrow night at the close.
I'm wondering what a tech company is right now, and which companies can actually take advantage of artificial intelligence and some of this technology. Very clear-cut, AMD or NVIDIA, but what about Meta? What about, just on a broader sense, other companies that could potentially gain from the productivity of investments in artificial intelligence? How do you value which companies will gain and which actually won't at all and potentially could even lose?
Yeah, listen, I think that's probably the most important question we get from investors right now. It's from a monetization perspective, who are going to be the biggest winners kind of from this AI boom? And that's really it's a tough question to answer. I'd say, to your point, kind of the easy answer right now is on the semiconductor side of things. It is on the infrastructure side of things, and kind of playing that. And that's clearly where the action has been here in recent weeks. Now, when you kind of look kind of more forward-looking in nature, when we think about some of the larger cap name stocks, I'd say Microsoft clearly at the top of the list in our view. I mean, with Copilot out there, with the potential to kind of see significant pricing power on that side of things, we think the line of sight is highly visible, and one where over the next decade should be a clear winner in our view. Now, other names like an Alphabet as well as Meta, we think are going to be a little bit tougher calls. And that's why you don't see kind of the multiple to the extent where you see that of the Microsofts of the world. And a big reason for that is, are they going to really get the ROI potential, or are they going to give advertisers out there the ROI from this AI boom? We think there is some kind of positives out there, but I don't think it's as clear as potentially a name like Microsoft out there.
So you can be a believer in this story, and I think that anyone who sees the way that people are using ChatGPT-like artificial intelligence has to be something of a believer, if not at least a very open recipient of this information. But you do have some naysayers out there about the valuation, basically saying that the rally that you have seen so far, 31% in big tech stocks so far this year, is at risk of petering out. This according to Citi analysts, basically saying that positioning is just such that it's rife for profit taking. I mean, do you sort of play into that? Do you just sort of look past that? Do you think that anything like that will just be a buying opportunity? How are you playing sort of the tactical ride up that we've seen in prices that can't really continue at this pace?
Yeah, I mean, listen, I mean, in terms of the performance here, there is, we think, going to be some sort of AI fatigue here potentially in the coming weeks, some sort of digestion that's probably going to be needed. Now, that said, I mean, we remain very big believers that the valuation actually is not as extended, I think, as many people out there think, especially as you kind of look out to a calendar 2024 basis for names like an NVIDIA and others, where kind of they are within their 5 to 10 year historical ranges, especially when you start thinking about kind of the growth tied to a number of these names. I'd also point to, names like a Microsoft and others, where, listen, at this point in time, I'd say kind of the risk to the downside on EPS estimates are probably very low, and there's probably upside potential to those estimates. So we kind of we want to be long on a lot of these names that are AI related. And I would say kind of you kind of want to have a basket of names. You don't want to put all your eggs in one basket, and you want to be buying kind of on any pullbacks. But listen, it's definitely gotten a bit hot to an extent, especially on the semi side of things. But the four names that we highlighted, we think continue to be the biggest winners and the names you want to buy on those pullbacks.
You want to be long. Some people feel like they have to be long. I was just going through the analyst recommendations. I love this. 49 buys, 8 holds, and one guy who couldn't care less about career risk with a sell. Now, Angelo, that's what I wanted to finish on. Do you sense the so-called career risk associated with this, given how quickly it's moving? Is there pressure that you have to be long?
I think that's a great point. I mean, listen, I think there's always risk of kind of, there's always risk on that side of things. But, we are fundamental by nature. And to us, the fundamentals are screaming buy right now. And for that reason, I think you continue to need to pound the table on these type of names. And I think especially on a name like NVIDIA, when you kind of look at the multiples at about low 40s on a calendar 24 basis, and then you look at the growth tied to it 3 to 5 years from now, and you kind of look at how early we are, if you're a believer of kind of, let's say, autonomous vehicles and what have you, there is risk to potentially having a sell to be tactical in nature rather than kind of beating kind of the table on the longer term outlook on these areas. And I think that's what you need to do for investors out there right now.
Interesting. Angelo, always great to hear from you. Thank you. Angelo Zeno there of CFRA. TK, the pressure if you've missed out on this so far year to date must be huge.
It's going to be huge, and I think you mentioned this yesterday. The pressure into the end of year for people behind.
Oof.
Window dressing this year, record level, given the oddities.
Andrew Sliman of Morgan Stanley talking about that. Emily Rowland of John Hancock Investment coming up next.
The moment news breaks, no one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
New York City, a $100,000 salary feels like just $36,000. That's according to a new study that looks at 76 of the largest U.S. cities to see where $100,000 goes the furthest, after taxes and after accounting for the cost of living. For many, reaching a six-figure salary is a huge moment when you feel like you finally made it. But that feeling may not last long when you realize just how much taxes and the cost of living in an expensive city takes out of your paycheck. And that's especially true after 2 years of inflation. Hybrid and remote work have opened up so many more opportunities for people to choose where they live. So that forces the question, should I stick it out in an expensive city or try to find somewhere more affordable? So where should you live if you want to maximize your salary? Consider Memphis, Tennessee. The home of the Blues topped the list with a take-home pay of about $86,000. Tennessee doesn't have an income tax, and the cost of living there is about 14% cheaper than the national average. So $1 there takes you much further. Texas is another popular choice, and it's clear why. 7 of the top 10 cities where $100,000 goes the furthest are in Texas, a state known for low taxes. Of course, there are so many factors that influence where you choose to live. You may want to be at the center of things, or be near family, or be somewhere where there are a lot of career opportunities in your field. It's not always just about dollars and cents.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
The problem's going to be is when people realize, wait a minute, look at these inflation numbers. They're coming back up instead of going down.
Inflation's likely going to be higher than it was in the last cycle.
What you're hearing from Fed officials is very much in line with what the data are showing, which is they're starting to get a little frustrated.
We're still pricing the Fed cutting before anyone else, and that bit I don't understand.
If I were a forecaster still, I am pretty sure I will put in a small recession later this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market slightly negative on the session. It is up big time on a month if you're looking at the NASDAQ. The S&P 500 doing okay as well. The equal weight. This has been the big distinction so far this month, so far year to date. Once you strip out the muscle of big tech, take away Nvidia, take away Meta. Tom, beneath the surface, there's a struggle there that you can't see. You can't see at the level of the NASDAQ 100 and elsewhere.
I would suggest like we've never seen before. I mean, the diversions here are amazing. Tomorrow we're going to have sell in May and go away statistics for you, June 1, but we're not going to do it today. But the answer is these are profound trends, and you listen to the Mr. Zeno we just spoke to at CFRA. These are trends that he suggests endures out 1 year, 2 years, 3 years.
Most people listening to this program right now hoping we don't talk about the debt ceiling story. That deal could go for a vote a little bit later today, and then we can move on, we hope.
But we had a good vote yesterday,
Friday.
right?
Payrolls on Friday, then on to CPI next month on June 13th, then on to the Federal Reserve. And if you're looking for some Fed speak this morning, in the Financial Times, Cleveland Fed President Loretta Mester teeing us up for what, Bramo? One more hike.
Right. And basically, she has been on the more hawkish side. But her talking about one more hike coheres with what we're seeing in markets, where there's this feeling growing that they could afford to go one more time. There has been a resilience. Consumers keep spending. Here's my key question heading into June. Are we at an inflection point? And this is what Oxford Economics had to say. Yes, we are. That all of the drivers of the first half of the year, whether it was China, whether it was some of the resilience that we see in consumer spending, are all set to roll over. If that's true, what happens to the indexes? They say range bound. I mean, again, this is sort of the conundrum of the economy on one side and markets on the other.
Well, you can see it in the weakness in European equities, in luxury this morning. You can see it in the underperformance in Chinese equities all year, for that matter. The reopening trade kind of really started in October and ended by the time we started 2023, just at the same time people were getting excited about it. But I'm with you. I think the breakdown in the European story is the one that's taken my attention in the last several weeks, Tom, in anticipation that maybe we'd have to push back against this idea that this is where you want to be, this is where the growth will be, this is where the equity market gains will be. More recently, that story has been challenged. And in the last hour, we heard from Steve Cheverone of Federated, and we heard that line that we talked about a few times in the last couple of weeks. Are we going back to so-called US equity market exceptionalism? And the problem that a lot of people have listening to this is that they have a real struggle on their hands. In the US equity market right now, are we on the brink of a melt up or a meltdown. And if you ask people, they'll be split one way or the other. There is no consensus out there on that.
The consensus has been some form of marginal move to international equities. Damien Sassauer was brilliant yesterday on where you find value in emerging market bonds. And time after time after time, you end up with some soup of resilient dollar, stronger dollar, diminished growth expectations off of what was looked at 6 months before. And that's right where we are right now. I'm going to go back to the IMF bombshell of April 6th. Are we framing out 3% global growth for 5 years? I don't think anybody is, including me.
Tom's on 105 watch on the euro.
Yeah, technically, you got it.
For many people who have booked a vacation to Europe, based here in America, you're probably also on 105 watch.
And below.
106.80, but trying to get back to parity.
You know.
Just saying there might be some bills in euros that might need to be paid. And for those funded in dollars, this might be a welcome development over the last couple of weeks or so. The broader market story, equity futures on the S&P 500 shaping up as follows. We look a little something like this, negative by 0.2%. Yields coming in just a bit, Lisa, here. We're down 4 basis points. The 10-year, 364.
Today, perhaps we'll get jolted with some data and with some Fed speak. But before we get there, we're getting that House vote on the debt limit deal that we're not sure exactly when it's going to come out. It is expected to pass. Then the Senate has to take hold. Then it has to get through before the June 5th drop dead date. We're all watching closely every single iteration and just praying that it is over soon. Today, we also do get JOLTS data at 10 a.m. This will be really key to get a sense of job openings, the soft data around how quickly the labor market is softening. And at 2 p.m., the Fed releases the Beige Book, which Tom will read in detail. And today, if you are looking for Fed speak, Boston Fed President Susan Collins, Fed Governor Michelle Bowman, Philly Fed President Patrick Harker, and Fed Governor Philip Jefferson. Curious to see whether there is a Loretta Mester vibe or whether she is truly an outlier, because right now she seems like more of an outlier than anything else. Yes, you have heard a bit more of a willingness to push back against the idea of rate cuts. But very few people outright are saying, you know what, yeah, it does look like we need another hike. And, oh, yeah, we do need to tighten more. There seems to be more of a reticence around the edges and a pushback from some of the members.
There's some splintering over the last couple of weeks. If you want to identify some consensus, 2 places. One, you mentioned, pushing back against cuts. 2, they don't want to commit to a pause just yet. You get a real sense of that on the committee going into next month's decision.
Especially because we don't know which way things are going to break. And this has been sort of the surprise. So the disinflation story, for example, the China story. We get the disinflation story out of Italy. We get the disinflation story, not Italy, excuse me, out of France. We get the disinflation story out of Spain. And then Italy comes and surprises to the upside with respect to inflation. So how do you really get a handle on what exactly is going on?
German inflation a little bit later as well. If you're interested in the views of JP Morgan's Jamie Dimon, conducted an interview with him overnight in Asia with our colleague, good friend Stephen Engel. Going to play some of that for you through the hour, so look out for that. Jamie Dimon on the debt ceiling, on China, and on US interest rates as well. Before we get there, we've got to catch up with Emily Rowland, co-chief investment strategist at John Hancock Investments. Emily, credit where it's due. I've been speaking to you all year. You push back against that Europe euphoria. You remain committed to the growth equity story. The United States over the rest of the world, not the rest of the world over the United States. Emily, are you sticking with it?
Yeah, John, we are, absolutely. And it does feel like markets are sort of getting the memo right now in terms of the macroeconomic environment. You know, we're looking at decelerating growth, as you all have mentioned, disappointing data overnight in China. This morning, we saw Japan industrial production and retail sales both disappointing, and you've seen this big rotation into U.S. markets, and that's been exhibited by a lot of the cross-asset action, seeing a bid for treasuries finally over the last couple of days here. You're seeing the dollar get a bid, and of course, this massive rotation into U.S. quality growth stocks, which we've talked about for some time. So that's got some key implications for portfolios, especially if you think about, you know, some of these trend-following strategies that have bought, you know, Japan, they've bought Europe based on positive price momentum. You might see that reverse and actually exacerbate some of the flows out of those areas of the market.
You're going to get me in trouble mentioning the trend following strategies. Emily, I'm glad you mentioned Japan. We haven't mentioned that this morning, and those were shocking numbers. Within this is sticky inflation. Everybody's doing real analysis, but we live in a nominal world. Are we going to be surprised by okay revenue growth that supports U.S. blue chips?
Well, I think it's a great point because inflation has definitely helped these companies that have a lot of pricing power, especially companies that have high operating leverage. And we've seen that be absolutely critical in terms of supporting margins. we think it's going to be hard to sustain that going forward. Of course, bottom line costs are elevated, whether it's the cost of capital, wage growth still fairly elevated, though there are signs that that's coming down. And then clearly demand is starting to slow. We're seeing that way back in the supply chain. If you look at things like the ISM index of new orders, which is our favorite leading indicator. No offense, I know everybody has a favorite leading indicator, but that's ours at John Hancock, and that's going to put pressure on margins. It's going to cause companies to need to defend their margins going forward, and that's ultimately going to result in the unemployment rate rising. We haven't seen that happen yet, but we think that that's something that comes in the next couple of quarters here.
There's been a growing theme in a lot of the notes that I've been reading about this inflection point that we seem to be coming up upon, not that just that we've been halfway through the year, but also that some of the main factors driving the first half are shifting. Do you see that as well? And what are going to be the features of this inflection point?
Yeah, well, some of the main drivers that have been supporting the market, we've talked about it, was really China reopening back in the fourth quarter of last year, and better weather in Europe, which caused this massive rotation into European equities. It caused the dollar to weaken, which really supported risk assets. There's been almost a perfect correlation with the dollar weakening and risk assets rallying and vice versa. And you're seeing some of those things shift now, again, as this rotation comes back to the U.S. The economic data, not great across the globe, but it's actually better in the U.S. right now, which is a big shift over the last couple of quarters. So stronger dollar, bid for treasuries. We think that's where some of the opportunities are from here. And I think that, again, the market action of the past couple of days to us makes a ton of sense, given the fact that we are in a decelerating growth environment and that recession is likely to unfold.
Emily, great call so far year to date on the equity market together with the team. Thank you. Emily Rowland of John Hancock Investment Management. Just on the FX market, we tested some pretty extreme levels going back to late September across a whole range of currency pairs. Let's pick up on the obvious one. Euro dollar, the single currency dropped to about 95. So right now 106.77. I don't see anyone out there right now suggesting that we can go back to those kind of levels. But I think these kind of levels have surprised a lot of people too, because there were some calls about getting back out to 115 on the euro. This is where the growth story would be. Remember when I went to London a couple of months ago and every guest lined up to say ECB is going to hike more than the Federal Reserve this year? They may well do, by the way. That might still be the case, but the story in foreign exchange has changed over the last month.
You know, end of May, this is sort of on my mind. I've mentioned it a couple times, and Emily Rowland mentions a slowdown in Japan. Obvious data in Tokyo, obvious data in China, obvious data in Europe, and this brings back within a terrible war, this idea of the innovation, the buoyancy, the ferment of Europe. Is that belief still there, or will it be tested?
I would tie that also to China, right? I mean, how much of the enthusiasm and the upside surprise in Europe was a complete lack of understanding of the impulse of the reopening, where it would take effect, how much, and how quickly it would run out. And that maybe is where we are now.
This is important. That's a dominant German field, maybe with the Netherlands as well in their manufacturing, export, import dynamic with China. I would suggest Lagarde and the others of Europe are going to have to worry about the many domestic stories of Europe much more than China. It's going to be like, okay, what are we doing in Finland? What are we doing in Hungary?
Sure. Agreed. I think with regards to China, though, there was a misunderstanding around the reopening, wasn't there? Manufacturing wasn't shut down at that point. Re-engaging in services was where the boom was going to be, and that's perhaps what we should focus a little bit more on. Bob Michael at JP Morgan coming up in about 20 minutes. Looking forward to that. From New York City this morning. Good morning.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The European Central Bank is hitting the final stretch of its interest rate hiking. ECB Vice President Luis de Guindos spoke to Bloomberg.
The news that we have received from several countries are very good, are very positive. They go in the right direction. Headline is declining. I think that we have run a very important part of the journey, and we are entering into the final stretch.
The ECB released its financial stability report today. Jamie Dimon says JP Morgan Chase will be in China in both good times and bad times, remaining committed to doing business in the Communist Party-ruled nation as political tensions grow. The CEO of the biggest U.S. bank also says he doesn't foresee a decoupling between the West and China.
Number of young people. Less trade. It'll take years for these things to take place, but it won't be a decoupling. and the world will go on.
Diamond's remarks comes as China-U.S. relations are at their worst in decades. Photos obtained by Bloomberg show Elon Musk at a restaurant in Beijing. The Tesla CEO met more government officials on the second day of his trip to China, having opened his first visit since before the pandemic by emphasizing the importance of maintaining ties with the nation. Now, Musk is expected to tour Tesla's Shanghai factory later today. And a hacking group with suspected ties to an Asian government has broadened its targets to government agencies in countries including Indonesia and Thailand. And that's according to cybersecurity firm Group IB. It says the perpetrators, dubbed Dark Pink, infiltrated targets in 5 new nations using sophisticated malware and phishing emails. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
So far, the jobs report has not been good news for the Fed.
3.4% unemployment.
That's not the picture Jay Powell thought he'd be looking at.
It really signals an employment market that's chugging along
miles from where the chairman of the Fed wants to be.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
It hasn't been a widespread job loss.
Tightening is yet to show up. Fed's not going to quit until the labor market quits.
The May Jobs Report, Friday on Bloomberg Television and Radio.
I'm not sure what in the bill people are concerned about. It is the largest savings of $2.1 trillion we've ever had. These are major victories. I understand people get upset about walking through a debt ceiling, but this is a House, a Senate, and a presidency.
We're going to make sure that the country does not default, but we also are going to make sure that Kevin McCarthy and my colleagues on the other side of the aisle, of course, uphold their end of the bargain, which is simply to produce a sufficient number of votes.
Classic effort to spin on Capitol Hill. Speaker McCarthy there with House Minority Leader Hakeem Jeffries. Hakeem Jeffries, by the way, catching up with our colleagues on Balance of Power, Anne-Marie and Joe Matthew down in Washington, D.C. It's about shaping the optics. House Democrats want to turn around and say, we're not going to default now because we're going to bail out our Republican colleagues who won't vote for the deal that Speaker McCarthy agreed to with the President of the United States. You can see how this is going to go, Bramo, down in Washington.
Painful. And yet, when you take a look at some of the substance of the bill, you can really see how the sausage is made, whether it's with respect to that West Virginia natural gas pipeline on one hand, whether the fact that a lot of Biden's initiatives were rolled back. They're still going to try to spin this as a victory. It's sort of this interesting moment of really cross-political wins.
Frustrating, Tom. That's the politics of the moment for you.
It's not Tuesday, it's Wednesday. It's a 4-day work week.
It is Wednesday.
Thank God that. That's Anne-Marie Horton did that. She dictated that we have 4-day work weeks from now
As she should.
Year. Anne-Marie Horton with us, Bloomberg Surveillance calendar correspondent here. She is exhausted like we all are by this battle. Anne-Marie, I want to go to the foolishness of this all. The Washington Post has Bishop of, I believe, the 8th Congressional District of North Carolina saying, quote, "This is a career-defining moment." This guy won with 69.9% of the vote in the last congressional election. Our dominant Republican congressman throwing moderate Republican congresspeople under the bus.
Well, there definitely is a little bit of a schism at the moment within the Republican Party on the House floor, but by and large, Republicans do expect 150 of them, around that number, and this is what Hakeem Jeffries, the Democratic minority leader, told us last night. That is what he is expecting Republicans to come and vote for this bill. There's obviously the House Freedom Caucus. They had a press conference yesterday. You had one of them, I believe it was Chip Roy, talking about a reckoning that he wants, and this is potentially why you hear swirling of this idea that there could be this motion to vacate for Speaker McCarthy because they wanted deeper spending cuts. But by and large, the majority of the Republicans say, we understand, we only control the House. Democrats control the Senate. They control the White House. And in that environment, we were still able to get a deal, and they want to back McCarthy. But certainly, this is, a divide within their party. But that divide has been there for years.
I mean, look, Anne-Marie, again, I want to go back to these X number of Republicans that are, standing up. And I guess if the vote was the other way, it'd be the X number of progressives as well. I have no recollection in the past of people winning in their hugely dominant congressional districts, putting at risk their party, putting at risk their speaker. To me, to you with your study of this and you're expert at this, is this a modern occurrence that these basically Southern congresspeople are putting at risk their party?
Well, they're leaning into some of the rhetoric we've seen from the former president, which does have a huge hold still on the Republican Party, about 30%. Remember, it was the former president who at the moment is actually the one that's been silent on the debt deal. We've heard from some of his challengers like Ron DeSantis and Nikki Haley coming out and bashing it. He's been silent at the moment. We know that he has been in touch through reporting from Speaker McCarthy. But it's that rhetoric that he had said where if they don't get the deep spending cuts, you should just default. And it's that kind of tone that many of these on the far right are taking, and they're taking back to their district.
Lisa, Ray Norman, South Carolina, over 60% of the vote in the last election. I mean, these are dominant winning Republicans. And I just wonder what they're doing to the moderate Republican group. To me, that's the story.
Which really feeds into the point, Anne-Marie, that you brought up with Ron DeSantis backing, or actually slamming this bill, not backing necessarily Kevin McCarthy. How much is the whole move to a middle not really the dominant theme when you take a look at the general election, when you take a look at the Republican and, frankly, the Democratic parties?
Well, that's how it goes, right? In the primaries, you go as hard as you can to your party's right or left, and then if you win it and you go to the general, you try to become a little bit more moderate as much as you can. I think one of the issues the governor is going to have as he kicks off this tour in Iowa, giving a number of speeches, attending a number of events, is when he bashes the debt ceiling bill. He was a member of Congress at one point not too long ago and voted to increase the debt ceiling without the deep spending cuts that he's now talking about. So this could potentially also hurt them, but this also just makes sense, right? They're all trying to play to a base. The former president has 30% of the Republican Party, and anyone that's going up against him and trying to challenge him is trying to knock at that 30% and trying to be someone that they think the rest of the Republican Party can coalesce around.
Meanwhile, we are hearing about new entrants into the Republican primary, potentially with Chris Christie of New Jersey potentially getting in on the game. What does this tell you, not necessarily about Chris Christie potentially winning, but also just with respect to the field?
Yeah, I think Axios reporting today that he plans to announce as early as next week. There was reporting earlier that, there's a super PAC building behind him. I think it just shows that we are a long way off from the U.S. election. It is next year in November, and you're going to see more names start to come into the race. I also think it's potentially a question mark on Governor DeSantis, which many thought he was going to be, you know, the heir apparent if it wasn't going to be Trump that could take on this race. Obviously, you've seen mega donors hit pause on him. There seems to be some concerns with whether or not it's taking on one of Florida's largest employers, Disney, whether or not his backtracking and how he feels about Russia's invasion of Ukraine. That definitely starts to irk and make, you know, the hair on Republican hawks start to rise. Then potentially others are starting to say, maybe there is a path for me. And it's not just Governor Christie, former Governor Christie, who we all know what makes it complicated for him is that he actually was a huge Trump ally, and now he goes on and bashes him and definitely does not agree with the former president. But others, there's reporting that Glenn Youngkin, the Virginia governor, is also taking a second look at potentially getting in this race.
So, AMH, you've got this anyone but Trump in the coalition of that within the Republican Party, and they're all diluting each other. They're hardly being heard. At some point, don't they all have to get around a table and decide who is going to be the challenger?
Yeah, I think one of the most interesting things Governor Sununu told Joe Matthew and I was early on, he said, what is so important about 2024 is when do you get out? Sure, open the field as wide as possible, make the scope and breadth of this race as wide and fruitful as possible. Let's have a proper debate, but know when to get out so that everyone can coalesce around someone else that is not the former president. The issue, of course, they all have is the former president just sucks up the oxygen in the room. Look, DeSantis is in Iowa, and he's trying to make this push there.
Yeah.
The former president's going to Iowa today. He's having a town hall with Sean Hannity that's going to air tomorrow. Very difficult for anyone to try to break through.
When do we get the next poll that shows how foolish this discussion is? What is Chris Christie polling? 2%?
Narrow. What I'm seeing right now, and I'm pulling up Real Clear Politic, is a very, very narrow margin, narrow market for him.
I yearn for London politics. I mean, it's just like...
Can be brutal, though, Tom.
Well, it's short. It's easier.
The best thing Anne-Marie said there is the election's a year and whatever away.
I know.
And we have, 14 Republican candidates?
It's more time for people to stand up.
You mean Lisa could run far
I'm
left of the
going to announce
Republican group.
right now that I am not going to run for office.
AMH, thank you. I know someone who might.
Yeah.
JP Morgan's Jamie Dimon. I love my country, and maybe one day I'll serve my country in one capacity or another.
Really not slamming down speculation of a run when a lot of people
It's
have
the
talked
greatest
about that.
trade in the world.
What?
You leave the bank, got all those shares, become the Treasury Secretary just for a heartbeat, and you make that trade. Oh, it's beautiful. Tax-free. Tax-free.
You think that's going to happen?
He's a patriot. That's not what this is about, okay? Be serious.
Okay, hold on a second.
you're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
Equities closing out the month of May, just a bit softer. Year to date, though, much better than anyone anticipated. Month to date, pretty decent too. On the Nasdaq, at least. On the Nasdaq 100 this morning, down by 0.2%. On the month, up by more than 8%. What a run that's been. Left behind the equal weight S&P 500. The market cap weighted stuff just about negative this morning by 0.3%. And this has been developing, and we've talked about this a million times over the last several weeks. This move in the Nasdaq has been developing even with this move in the 2-year, in the bond market. Take a look at Treasuries this morning. Yields come back a little bit by a couple of basis points, but the fact we're at 442 and up on the month by something like 40 basis points, and still we've managed to grind out a gain of more than 8% on the Nasdaq 100. You can thank the likes of Nvidia and others for that one. Thank China for this one. A weaker euro. PMI's out overnight. As soon as they drop weaker, bang, euro weaker too. 106.83. Breaker 107 in the last 24 hours. Haven't seen 108 for about a week now. Will we see it again anytime soon, based on the incoming information we're getting from China at the moment, Lisa, which is weak growth, weak growth?
And how much is this really going to drive the narrative for the second half of the year? The first half of the year really was dollar weaker, China growth, then weaker China and dollar strength. Do we get sort of the opposite coming in? I'm looking at some specific names. We want to look at NVIDIA. It has soared 31% over the past 3 sessions. It's taking some profits right now. You can feel that kind of churn right now. That's not going to drive the market, and that's why perhaps you're seeing a bit of sogginess in the market. Hewlett-Packard Enterprise, I think, is interesting. Those shares lower by 8.3%. Those shares largely down on the year already. And what this shows to me, yes, they had second quarter revenue and current quarter forecasts that were below expectations, but still, to me, it's the have and the have-nots. It's not just a tech story. There are some pretty big losers underneath the tech story, even still. And Avis up after Deutsche Bank recommending that people buy simply on a valuation story. Those shares are lower on the year, even though people have been renting cars. Again, what I find interesting is the churn. These stories that people are just looking to pounce on maybe for a day, 2 days, for a valuation story, not necessarily because of a fundamental issue.
We call that a valuation trap, is what we call that.
Well, what this is called is a market that doesn't have a clear direction. And even if you have a clear view on the economy, it's not clear that the market will cohere with that based on some of the big drivers of the gain so far this year.
Car rentals are just a money pit, right? You notice that? You turn up, sticker price is never the price, particularly in Europe. I have this difficulty. Whenever we used to go as a family, it was always problematic. You go to Europe, not going to pick on a name, Hertz, Avis, whoever you want. You'd go over to Europe, it would always be a problem. It would never be the sticker price.
Of course not. You have all the fees. If you get sucked into the insurance, the extra added insurance based on your own insurance, if you're going to do that, that's another fee. If you have gas or not gas, all of these like questions, you sort of no. And then if you crash the car, you're screwed.
You get into the parking lot, family of 5, Fiat 500. You know, that's always the way. You can see my childhood. Slew of Fed speak today. Collins, Bowman, Harker, Jefferson on tap. Cleveland Fed President Loretta Mester speaking to the FT and saying, quote, "I don't really see a compelling reason to pause. I would see more of a compelling case for bringing rates up and then holding for a while until you get less uncertain about where the economy is going." Here's some good news. Bob Michael takes the other side of that, of JP Morgan Asset Management, saying that we are going to get a pause. We expect the Fed to pause hiking rates at the June FOMC meeting and believe we have seen the last rate hike for this cycle. And the good news for Bob Michael is it sounds like his boss agrees with him. Take a listen.
You know, my simple view is that, you know, their right to pause at this point has been a big increase, you know, 500 basis points or so. Take a pause. But I do think it's possible they're going to have to raise a little bit more.
Take a pause. It sounds like a Fed official. Ready to go.
No, he looks like
Treasury
Secretary.
Secretary. Right, okay.
He looks Mellon-like.
Ready to serve the country.
Andrew Mellon, yeah.
Yeah.
Did you see Bob Michael as undersecretary?
I can see that happening.
I can see that. Joining us now, Robert Michael. Bob Michael, head of fixed income, JP Morgan Asset Management. And I want to go back to 1984. You're a youngling at Bankers Trust. Ian Rush is with Liverpool. They're doing better than good. This is way, way back. And the basic idea is we used to clip coupons. Would you be sitting with Mr. Diamond now saying that we can make coupon and total return now? Are we going to see price up, yield down in a basic bond portfolio?
I can't tell you how relieved I am not to hear him tell me that I should be preparing for 7%. So I'll take what I can from him, that we're due for a pause and that should relax the markets. No, 100%. This is the time where you clip coupons because yields have reset materially higher from where they were at the end of 2021. Actually, when you look at real yields in the bond market, they're the highest level going back 15, 17 years. We're going to get some capital appreciation on top of the coupon clipping. I'm looking for close to double-digit returns on the Bloomberg aggregate over the next year.
This is a key statement, and what's important about this is Mr. Diamond back to Bank One actually knows what an S&P Blue Book is. I mean, you have a Blue Book and you have bonds in it, you go through and you try to buy bonds for price up, yield down. Which kind of bonds will give you the best pop there to get your double-digit return?
Well, we're certainly intermediate government bonds look good to us. So we're thinking the 5-year Treasury. We feel we've been given a gift in here with the backup in yields. Sure, we swung a little bit low in yields. The market got all excited. Now it's going the other way. We do think that we're going to see 3% across the coupon curve by the end of the summer, and the 5-year seems to be the sweet spot. So we like that. And then we like high quality credit. So for sure, we're going into investment grade corporates. We're actually starting to see a lot of overseas investors returning to the U.S. investment grade corporate bond market. They're attracted by the yields there.
The yields are, John, and it falls right into the disinflation, deflationary Chinese impulse.
Let's unpack some of this.
Huge statement.
Just on the yield curve, for people who aren't familiar with what drives different parts of the yield curve, what is special about a 5-year maturity? Why is that the sweet spot for you?
Because it gives you a couple of things. One, it gives you a reasonably high level of yield. Sure, it's not cash. Cash is sitting out there at over 5%, but that's the cash trap at this part of the cycle. You put money there, and then a year from now, it's gone. Your cash run rate is probably below 4% a year from now. So you've lost all of that, and then the yield curve starts to adjust to a central bank that's cutting rates again. We still think we're going to be in recession by the end of the year. Everything that's happened so far this year continues to tell us end of the year recession and first Fed rate cut in September. And I know the recent data throws some of that into speculation. Not in our book. Things are playing out the way they should exactly.
So 5-year in the Treasury market, got it, okay. IG, tons of demand coming from abroad, got that, okay. High yield, you've got within your call a rate cut call in September. Does it make sense to be buying high yield and taking more credit risk at a time where the Fed's going to be cutting rates because you anticipate the economy is going to weaken?
So I'm listening to the conversation at the start about the equity market and how we're isolating NVIDIA, and a couple things have driven this rally, but there are other things that are lagging. Now, I'm a bond guy, which makes me an equity market expert, but I see a lot of... I see a lot of... Yeah, exactly. I see a lot of what's going on in the equity market and the high yield market, and we've parsed through all of this. And what you're looking at is the CCC universe is 1,000 basis points over, so it's already coming under pressure. And the double B universe is in the 300s over. So that differentiation is already occurring. This is very different than where we were back in August, September. Whenever we hit 600 basis points over, pretty much most of the market was about 600 basis points over. That was probably the time to take a shot over the near term. Now is not. Now the market is telling you there is differentiation beneath the surface. Investors are seeing cracks forming, and they're trying to get out of the way.
You said that things are playing out as they should, to get to a recession by the end of the year and to get a Fed to cut rates by September. Does that mean that we're in this sort of inflection point, that we're going to see a rapid deceleration in some of the economic data in a way that we just haven't yet, with all the upside surprises?
Absolutely. And we've talked about this before. From the last Fed rate hike until recession, it's historically averaged about a 13-month period. So that long and variable takes time. We're now getting into a year and a quarter. We're going to start hitting the window when the 475 basis point rate hikes start to hit. And you're already hearing about the funding pressure to businesses and households at a higher rate level. It's causing them to rethink things. And then the higher cost of everything, that's causing them to rededicate where their spending goes to. So that catch up is coming. And some of the inflation data we're looking at, Europe overnight or this morning, came in soft. And I know Italy surprised a little bit to the upside, but everything seems to be slowing down. The one thing that seems to have gone under the radar, forget about what's going on in China, look at the Bloomberg Commodities Index. It was 140-ish about a year ago. It's below 100 now. And the trend is diving south at a rate that you only see headed into recession. So the weakness is there. The cumulative and lagged are catching up.
This is important. A lot of people push back against commodities being a real signal this time around. They say this time is different with a lot of different things, and I could see.
Right, you don't use them for anything.
But hold on a second. But here's the issue. People saying that because of China and the inability to get that right, because of Russia and their willingness to pump much more than their allotted amount to try to get money to fund the war, because of all of these issues, you're seeing distortions in the commodity market that do not comply with what you're seeing on the ground. How much are you using this as a key signal saying we're where we should be?
Well, you still have very low unemployment in the U.S. Everyone's talking about 3.5% unemployment. Everyone's talking about wages have gone up and that there's a stickiness to core inflation. Everyone's talking about consumers want to spend on travel and leisure, so that the demand is there. But if the demand is at a high enough level, you are going to see commodities prices pushed higher. People are spending on things and buying things. It's just not at a rate that sustains itself with the amount of supply we're now seeing. The bottlenecks have cleared.
Bob, this is awesome. We're going to talk more about this. Bob Michael at JP Morgan Asset Management is going to be sticking with us. This long-held view over the last several months, Tom, that I think has got your attention, my attention, Lisa's attention as well. It's the whole curve back down to 3%, and these cuts come in September.
A number of houses have this call, and with it, optimism, price up, yield down, but I would say it's an outlier call right now. I mean, I think people are just inured to these high yields that we see, and maybe they drift away with the debt ceiling getting fixed, but we're going to come back and talk about this. It's important.
That conversation coming up shortly. Right now, your 2-year at about 442. Right now, your equity market near session lows, just off them. We're down by 0.4%. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The debt limit deal heads to a House vote today after squeaking through the House Rules Committee by a 7-6 margin. Meanwhile, JP Morgan Chase Chief Executive Officer Jamie Dimon says he's optimistic about it.
So I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down, spoke, got something done.
The nonpartisan Congressional Budget Office estimates the deal would cut deficits by $1.5 trillion over a decade. The U.S. urged Serbia and Kosovo to immediately de-escalate tensions in northern Kosovo after clashes injured dozens of peacekeepers and protesters. U.S. Secretary of State Antony Blinken blamed Kosovo's Prime Minister Albin Kurti's government for, quote, unnecessarily inflaming ties with the minority Serb community. Now, Blinken urged newly elected ethnic Albanian mayors to avoid working in predominantly Serb towns where violence erupted this week. South Korea's spy agency says North Korean leader Kim Jong-un may be suffering from a sleep disorder. The National Intelligence Service says North Korean authorities are intensely collecting overseas medical information for top-ranking officials with insomnia, including details on medications used to treat it. Meanwhile, North Korea has confirmed that an effort to launch a military spy satellite into orbit failed. The official news agency reported a rocket crashed into the Yellow Sea after losing propulsion in the second stage of the ascent. The launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. I'm Lisa Mateo. This is Bloomberg.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but, we're monitoring the situation very carefully.
Nobody covers business like Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
A record year of growth, hand over fist all year.
We're just getting started.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Today on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
When we do business in a country, and we do business in 100 countries around the world, we are there for the citizens of the country. And we're there, hopefully, through good times and bad times. We tend not to leave. If you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China's obviously going to do what they think is good for itself.
JP Morgan Chase CEO Jamie Dimon back in Shanghai. Not the only one this week, actually. Not just JP Morgan's Jamie Dimon, but also Tesla's Elon Musk over in China as well, talking to the government. We should go too?
We should go.
You'd like
Absolutely.
to make that happen?
To the show on top of the Peace Hotel at the Bund in Shanghai.
Isn't it nighttime?
Yeah, but, sunsetting, through the
romantic.
It's very romantic. I was looking at our Hong Kong building once, and I saw the rain coming in, and the lovely next to me informed me, Tom, that's not rain, that's smog. No, the rain was coming in, John.
I've heard this story before. Yeah,
you
told me that. Yeah.
Okay.
Yeah. Like old jokes recycled.
Yeah.
Yeah. Okay, let's.
We're gonna move forward.
Granddad, we did this. You told me 5 minutes ago.
John, save me. John, save me. Euro 106.82.
Okay. What do you want me to say about it? Data out of China.
It's a big deal.
Data out of China weaker than expected overnight. And you can plot the chart, by the way. Just go intraday, look at the time where the China data dropped, which I think was like 9:30 Eastern time, and you can see straight afterwards, Euro Boom.
Oil 67.54. We continue with Bob Michael. What a pleasure to have him for the entire half hour ahead of fixed income. JP Morgan Asset Management. I want to recapitulate what you said in the previous section. You are looking in the vicinity of Labor Day for a 3% market. Nobody listening or watching believes you. That's massive price up, yield down, isn't it?
It is. And, you know, we talked a little bit during the break about 2008, and I want to go back to that because March to June 2008, while the world's property market was melting under our feet, the 5-year Treasury went from 220 to 3.75%. It rose 155 basis points. This time, 75 basis points, it's laughable. So you can have these counter-trend sell-offs in the market, but the broader trend is growth is coming down, inflation is coming down. The peak in inflation, the peak in bond yields was last year. We're going to have lower highs and lower lows.
And John, this folds right into that stunning headline a couple weeks ago from John Williams of the New York Fed, looking at an R-star, which is a lower rate regime.
Before we get there, I want to talk about what's happening in the property market. It's one of those things that we can all see in commercial real estate. We can all see it with our own eyes, what's developing in cities across this country and elsewhere. And then you speak to professionals in the market who know about CRE and this important stuff that I don't get. They tell me everything's okay. It's going to be all right. This isn't going to be a problem. There's no crisis here. What do you see?
I see an imbalance. I've traveled through the U.S. a lot this year. I've been to 9 cities. Suburban office space demand is very, very high. But when you go into central business districts, the offices are empty. And those used to be flagship properties before COVID hit. So I go back to 2019. I think about all the commercial mortgage-backed securitizations we bought. I think of the REITs that were put together. What you wanted to see in there was central business district office space. It was 99% leased. And what's going on now is there's nobody in these buildings, but the leasing rate has dropped from 99% to 85%. So the appraiser comes in and revalues it for that, not for the fact that as more leases come due, they're not going to roll over. So I do get very concerned about that. It again reminds me, and I don't want to keep going back to 2008, remember the subprime residential real estate market? It's so small. It's not the U.S. housing market. It doesn't mean anything. And I'm hearing the same garbage about central business district office space. It is significant. It was the flagship trophy properties, and these buildings are still largely empty in too many cities.
The big pushback that I hear from people when I raise this concern is this time is different because the leases are much longer. It will take time for them to roll over, so there's some capital that's been locked in. A lot of the revaluation has been happening already in a very controlled way, and there are bidders that are coming in. How do you push back in the sense that this might not be necessarily a slow rolling depreciation that can be controlled into something that will force the downturn to accelerate and the Fed to cut rates?
I think at some point in time, the cost of carry is too great. And I think about Houston property in the early 80s when everyone talked about, oh, you know, oil price collapse. If you could just afford to carry this property, you could make a ton of money. And guess what? You couldn't. People were going to the sale of their homes and writing checks for somebody to take their house. So yeah, Houston property came back in a big way, but at some point you just get tired of carrying the property. We're seeing some of that already where you see the property holders in some commercial mortgage-backed securitizations go, you know what, here's the level of debt, here's what I think the properties are worth, here are the keys, good luck to you.
So just to put a bow on this, there is this issue of whether you think that commercial property devaluation is what's going to trigger the Fed to be forced to come in and cut rates, a call that is out of consensus at a time when the Fed wants to push back against just that kind of idea.
Well, it's not just commercial property. I'm not sure how we wound up there, but there are a lot of other things going on, right? The regional banking system is still on life support. Many of the regional banks have their entire securities portfolios on repo to the Fed at par. and they're trading in the 90s, and they've got that cash at par sitting there to meet depositor outflows. Their loan portfolios put in place when SOFR was 1/8, not 5 1/8, those are underwater too. Those are now with the Federal Home Loan Bank, so they have cash to meet depositor outflows. We'll know in 2 months from now when we get bank earnings what's happened with depositor outflows. My impression is there's still outflows at the regional banks. We don't know how the regional banks will operate until the Fed, the FDIC, the Federal Home Loan Bank are out of the picture, and we're a long way from that. Commercial properties, the second. The third is just the cost of funding corporate America. As I said, you had an infinite pool of free money available for several years. SOFR was 1/8%. Sure, you're a below investment grade borrower, slap a 4 or 5% credit cost on it. There's your 4 or 5% borrowing rate. Now you're in the double digits, and more of that will be rolling through. I think those are the concerns out there. I do look at the commodity index. I do think inflation is going to fall off a cliff here, and I think the Fed's got this wrong.
You've got 60 seconds left. Huge amount of T-bill issuance is going to come very shortly. Just quickly, with everything you've just said, is that a problem?
It shouldn't be. I'm hoping that it gives banks and money market funds somewhere else to put their money other than overnight reverse repo with the Fed. So maybe that will give us another avenue to invest.
Bob, this was a clinic. Need to do this more often. Come into the studio again. More guests coming around the table for a couple of blocks.
It's fun.
You know, it's fun. It's good to see you.
They come to Midtown, they talk about the crisis in commercial real estate because it's all emptied out. I mean, that's sort of the issue.
We're the only people around.
Exactly.
So you just want to drop by and have a cup of tea and chat. It's lonely out there.
John,
it's lonely out there in Midtown Manhattan.
John, my anecdotal is it's at least the same, if not it's gotten worse. I don't know what the cheerleaders are saying right now, but it's stunning just to drive through Midtown.
Well, they like to look at what's happening with the subway and what the volume looks like there, and at the airports and that stuff. Look, I see the offices. We all see it. There's no one around.
Yeah.
Not in the offices. They are, going out to eat. They are. I mean,
that's James Gorman's problem, wasn't it?
But that's exactly it. I mean, people are still going back to the cities in droves. It's just not the offices.
Oh, I see them out in the town on the weekend.
Oh,
sure. I mean, but, this is what James Gorman and Morgan Stanley said. The restaurants are still packed. Be very clear about that. The restaurants are still packed.
Yeah.
The offices are not. I'll say this, Bob, don't worry, we'll let you go. The banks, I love the banks who say that we've got to get back to work, get back to work. I saw a wonderful take on this. Get back to work. But then it comes to banking and they cut branches because you don't need to do banking in person anymore. But you do need to do banking in person within the bank. It's just, you can do it remotely.
I'm biased with this. Yes, but I'm biased with this.
If you're the client, the customer, you don't need the branch anymore, I'm told.
But
if you work there, you've got to be there.
You hear some frustrated people. Is that what
Because the culture's important. The culture's important.
Oh, boy.
Update for Bloomberg TV and radio from Tennis Channel. I'm Andrew Guy. Tuesday saw a huge upset in the men's draw as former U.S. Open champion Daniil Medvedev crashed out in the opening round against qualifier Thiago Seyboth-Wild. The Brazilian hit 69 winners in the victory, which was his first in the main draw at a major. And don't forget, you can watch all the action live on Tennis Channel. Our daily coverage starts at 5 a.m. Eastern. I'm Andrew Guy. We'll see you there.
I'm going to name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
We had a long-standing presence here in Houston for the past, I would say, 20-some years, since the Compaq merger. We bought a piece of land, we started building this building. And in doing so, we had to also recalibrate how we were building it because the pandemic hit us. And we thought about recreating a work environment that is very, very different, that is catered for this new structural way of working, which we call edge to office, where people don't always come to the office to work, can work remotely from their homes, their edges, but have to come back to the office for specific reasons, such as team meetings, customer meetings, and in general, collaboration.
With regards to the hybrid work model, do you see that as something that will persist longer term when the pandemic is long gone?
Yes, no question, this will persist.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The economy's in a bit of a weird spot, right?
I'd say that these markets are playing out as you would expect them to play out.
We're concerned about the equity market because it has had such a strong run.
The big shift has been equities and bonds becoming positively correlated.
The U.S. economy is in a very different place from the rest of the world.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. A China slowdown, a commodity slowdown. Bob Michael looking for 3% at yields out to Labor Day. And John leading the way in that commodity slowdown. American oil, $67.53. Nothing else has to be said today.
Welcome news for some central bankers, I'd say, Tom, for price pressure. Germany just out with inflation, yes. Looking at inflation coming in below expectations and well south of the previous month as well. You put it all together, though, fact of the matter is we still have a 6 handle on CPI over in Germany, Tom, and the pressure will be on the ECB to hike once again on June 15th, I believe.
The vector going the right way in France, in Spain, now in Germany, and Emily Rowland mentioning with John Hancock earlier, Japan out with a slower set of economic data today. That is the trend of the morning, again seen in oil and that weaker euro.
Growth is going with it, and as anticipated, and front and center are those PMIs out of China overnight. Manufacturing well south of 50 now. That's the line in the sand between expansion and contraction, and clearly in contractionary territory, both in China and in Europe too. And that's why, Tom, we've got a euro that's back down to 106 and not north of 110.
And what's fascinating here, Lisa, is the response. I guess as we talk about the response from the Fed. You've got a whole bunch of Fed speakers today. The response from Europe, the response from Lagarde. How does Beijing respond to this, given the politics of the moment?
The question around stimulus and how much ammunition they actually have. We heard from Bill Lee that they don't necessarily want to increase their debt limit. Jamie Dimon was pretty positive, continuing to be diplomatic and be there. John, as you pointed out, they might be more targeted with respect to how they stimulate specific industries. The larger takeaway here is, yes, disinflation, but the flip side of that is, as you were talking about, slower growth. So are we on the the tipping point, I keep going back to this, tipping point of just sort of a moderation, an immaculate disinflation, or something that's a little bit more violent, akin to what Bob Michael was just talking about.
We've still got a massive distinction between manufacturing data bad and services data pretty decent. That's true in Europe, that's true in the United States, and in some way, shape or form true in China too.
Which perhaps is the reason why you saw Italy, for example, surprised to the upside with respect to how much inflation was coming down, because maybe there's more of a services side of the economy and less of the manufacturing side. And Germany is going to disappoint. The point here is, how do you put these together? Which is going to catch up with which at a time when people are still flying around at an incredible pace?
Still pandemic economics. Still, we had this massive pull forward of demand of certain things. Goods, we wanted to buy stuff. We had to push out demand for services, couldn't engage with the economy in quite the same way. Go to an airport at a city near to you and you'll see what we're talking about.
Yes.
Ramo, you lived it over the weekend. It's kind of crazy right now. So services are screaming, let's go, hike. Manufacturing screaming, let's go, cut. And to your point, how that settles out in the coming quarters is going to be the story, I think, ultimately for the year.
And just when you take a look at forward-looking, we didn't even mention this, American Air came out and basically increased its expectation for its earnings because of exactly that kind of trend. You take a look, though, at what's going on in the commodity space, and it does raise a red flag that's hard to ignore. And I think that's the reason why people keep gripping onto
For
it.
exclusive NVIDIA, under $1 trillion.
There we go. We're tracking that one closely. Where are we now, Tom?
394, we're down 1.7% off yesterday. But, it's amazing how 24 hours ago it was about AI and tech to the moon. And now we're looking at that global slowdown again back to April 6th and what IMF called for.
Well, I think it's part of the same story, isn't it?
Yes, I think that's a really important concept of, frankly, technology substituting for so much more, and that's how you get to that manufacturing.
We were all
slowdown.
Searching for growth over the last 10 years, and we found it in equity stories, and that was basically the FANG story of much of the last decade, Tom, with low levels of growth, inflation, low rates, all of the above. What's been curious about this year, as we came into this year, and I think we've kept going on about this, about how we've just eaten away at consensus views, just hammered away at them. Year to date, tech not going to do well. Last year was ugly. Guess what? Tech ripping. NVIDIA, fantastic. Consensus view, China reopening. That's where you want to be.
That worked out.
China, equity market, bear market. The dollar gets short the dollar, get long the euro.
That worked out.
The euro back down to 107. Take your pick. Just kind of beating up on consensus positions across the board.
Can I just apologize to whoever is watching this and just throwing things at the screen? Like, why? Why are you having to pick on me? But it's so many people.
We're coming up tomorrow. We're going to have our sell in May and go away summary here. And I'm sorry, that's what the data is. And John, you see it in DXY 104.42. Give us a little bit of data here.
It's sell in May. NASDAQ 100 up 8% for the month and some. Pulls back a bit. We're down about 0.4% on NASDAQ futures this morning. On the S&P 500, similar move on the S&P, and we pull back on yields. Down by 4 basis points, Tom, 364.
Alex Chaloff to provide clarity here, CIO Bernstein Private Wealth Management is way. You got to write a mid-year review, Alex. What do you do here? How do you change from 12/31 after the surprises of the first 5 months of the year?
Yeah, Tom, actually, I'm going to have ChatGPT write the first paragraph of my mid-year review, and then I'll write the second one, and I'll just throw it back to our Bernstein clients to tell me which one they think does a better job. But look, we're clearly in a transition period. We're going to have an earnings recession in the back half of the year, and I know people in the financial services industry always talk about the back half of the year. It's never now. It's always, in the back half, this X, Y, or Z will happen. But it's clear that earnings have to come down from where they are. Market's pricing in 2024 more than it is 23, looking past potential pause, potential hike, one more priced in, looking past the debt ceiling morass, which we would agree you should look past. But this is all about next year at this point. I think that's part of the reason why the market's behaving the way that it is. Investors are looking to next year.
What are people getting wrong right now? And I say this with great humility because everyone seemed to get everything wrong heading into this year, including us, including myself. I'm just wondering, from your vantage point, where potentially the framework could be off.
Well, I think that there's a broad narrative that the market, air quotation mark, is up. And it's true, the S&P obviously is up nicely this year, but it's probably the thinnest rally that we've seen forever. Just a couple minutes ago, I was on my Bloomberg, and I put in SPW Index GP Go, and that's I should have said that to do that earlier, but that's the equal weighted. If you look at that index, it's negative for the year through last night. So S&P, the market cap is up 9.5, but the equal weighted is basically 0. That's a 10% spread. So I think what people are missing, oh, there you go. Oh, that's the futures, never mind. What people are missing is the fact that it's not the market that's up, it's just a handful of companies. And so there are attractive opportunities outside of things that have really moved. And I would argue it's maybe a little bit early, but time to fight the momentum trade and look at other areas that should benefit over the next 12 months.
Are you going more into bonds? And I'm piggybacking off of what Bob Michael of JP Morgan was just talking about, this idea that we could end up at a 3% level for the entire yield curve with people piling into bonds, the Fed cutting rates by September, and a full-blown recession underway by the end of the year. Do you take that view as well?
Full-blown recession is probably a little bit overstated, but your original question, are you going back into bonds? We never left bonds. We have weathered the storm in bonds, particularly in munis, and have enjoyed the rally really since last fall. I think that's the secret that not a lot of investors have appreciated, that munis have been really quite strong over the last 7 months. If you look at what's going on in the bond market today, you're definitely, the yields are much juicier than they were a year or 2 years ago. The credit issues, I would say municipals have come off the board. You've got to be very picky in corporates, be very selective around credit. But there isn't the risk of, in our view, a deep recession. We will be in recession. Our view for U.S. GDP this year has a negative on it. It's negative 0.1, but it's basically a 0. And to get a 0 for the full year means the back half is a recession. But our view is that the strength in the labor markets is much stronger than any of the other negative forces. And we muddle through and we get through to the other side.
It's amazing to see 3.4% unemployment in America still. Alex, we've got to leave it there. Alex Sholoff there of Bernstein Private Wealth Management. Just on that distinction, that difference between the outperformance on, say, market cap, S&P. Take the NASDAQ 100 this month. If you're just tuning in, I'll go over those numbers again. It's up more than 8% this month. Equal weight S&P is down 3% month to date. That's 11 points of outperformance, Tom, in a single month.
And by no means am I saying buy, hold, sell. Everybody knows I'm very comfortable in triple leveraged all cash. I looked at Procter & Gamble, I looked at Walmart. These are stocks, John, trading at 20 multiples, huge multiples given their revenue growth, the stolid nature of what they've got. Take a troubled company. We all know 3M is troubled. They're down 62% from their 2018 high. They're down 47% since the beginning of last year. And let me tell you, there's no bid on the stock right now, pricing back to 2013. You can enjoy 3M this morning at under a 10 multiple.
Wow.
I mean, it's trading like Ford Motor Company. But is that how you describe a value trap? And again, I don't want to go into buy, hold, sell here. I'm just saying within security selection, what's really the value of a 12 multiple now or a 9 multiple? You got to be careful out there.
Or on certain stocks where multiples just don't seem to matter at all. Like Nvidia, which is just absolutely flying. That's the equity story on bond markets. We'll catch up with Jean Bavin of BlackRock in the next hour on Bloomberg TV. Got a very, very interesting call. Fixed income is back. Hear that a lot. Fixed income is back. The income part of fixed income is back, yes. But do you get, or will you get, the inverse correlation to risk assets to diversify the portfolio? Now, what Jean Bavin's got to say on the bond market is, yes, for income, front end okay. What he's saying further down the curve, because he thinks inflation is going to be sticky and the Federal Reserve won't bail people out with rate cuts, he's saying that the 10-year won't give you that performance in quite the same way. I find that interesting.
I find that fascinating. It goes against what Bob Michael is talking about, but it's this fear that the 60-40 won't work. And a lot of people are sticking with that belief and looking for diversification in other ways.
That's tricky. Right now, equity futures just a little bit negative on the S&P 500, going into the opening bell to close out the month of May with another big month of gains for tech stocks.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The debt limit deal heads to a House vote today after squeaking through the House Rules Committee by a 7-6 margin. The nonpartisan Congressional Budget Office estimates the deal would cut deficits by $1.5 trillion over a decade. Meanwhile, U.S. House Speaker Kevin McCarthy has dismissed threats from Republican hardliners to remove him from his job. The U.S. and European allies urged caution on whether Ukraine should have the right to strike inside Russia. Countries supporting Ukraine are taking varying stances on how it should beat back Moscow's invasion, as Russian territory is increasingly targeted. The U.S. has publicly leaned against the strategy of attacks within Russia. Foreign ministers of the North Atlantic Treaty Organization countries began a two-day meeting in Oslo. Well, they'll discuss Ukraine's bid to join the military alliance, as well as how to boost defense spending. The U.S. urged Serbia and Kosovo to immediately de-escalate tensions in northern Kosovo after clashes injured dozens of peacekeepers and protesters. U.S. Secretary of State Antony Blinken blamed Kosovo's Prime Minister Albin Kurti's government for, quote, unnecessarily inflaming ties with the minority Serb community. Blinken urged newly elected ethnic Albanian mayors to avoid working in predominantly Serb towns where violence erupted this week. Biden administration officials are divided over how aggressively new artificial intelligence tools should be regulated. Some White House and Commerce Department officials support the strong measures proposed by the European Union for AI products. Meanwhile, U.S. national security officials and some in the State Department say aggressive regulation will put the U.S. at a competitive disadvantage to China. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
City, from London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
DOJ or other authorities.
Could face bigger challenges.
Was going to keep rating World Cup. This is a 3.
As the economic picture does.
The OK is getting ready to make a decision.
I wish that one day we get rid of the whole debt ceiling thing, but I understand when, it's a democracy, people have different opinions about what we should be doing, and it's just one tool for one party to, get the other party to the table. So I'm quite optimistic there, and I really do applaud the fact that they all sat down, spoke, got something done. I think it's going to happen. If I thought it wasn't going to happen, I probably wouldn't be here right now.
It goes to a vote in the House, and Jamie Dimon at JP Morgan thinks that vote will pass, as do many other people. The fact of the matter is he's in China, and he is not in the United States, and I think most CEOs share this view right now, Tom, that this thing will pass.
Yeah, I think after the vote yesterday, Anne-Marie Hordern said that was very important. I believe it was 7-6. I mean, 7-6 is the same as 10 to whatever. I mean, the fact is it passed.
It's tight, though. It's tight. Yeah, I'm with you. It's just
supposed
funny.
to be tight.
I think Jamie Dimon alluded to this, that ultimately this has become the mechanism to actually have a negotiation about the budget in America, because we don't often do that, Tom, do we? The White House comes with a budget and everyone's like, budget, nah. Whatever.
I agree, and there's a cardinal rule: fiscal policy doesn't matter in elections. That's tattooed to everybody's brain, both sides of the aisle. The first Tuesday in November, debt, deficit, budgets, it's not up the chain of issues.
I'd say the other way
Anne-Marie
around.
Horton taught me
It
that.
doesn't seem to matter when you're in power.
It
Doesn't seem to matter when you're in power. It seems to matter more when you're out of power. Have you noticed that's a trend?
Nobody wants to come out and say, we're going to cut your Social Security checks. That is basically political kryptonite. But there is this issue, and we're going to hear this more, and we did hear this from Ron DeSantis. How much is this going to be a talking point this time around?
We're going to go to the congressman from in between the Cubs and the Brewers, Janesville, Wisconsin. Brian Stile joins us now, Republican from Wisconsin, with all that heritage of former Speaker Paul Ryan. Congressman, I'm going to go back to the election of 2018. You won with 51, maybe 52% of the vote. You've done better in recent elections, doing better, like 60% or whatever. I want you to comment on the vociferous conservative Republicans and what they're doing to Republicans who are more middle of the road. What is the damage being done by the strident Republicans to those more in the middle of the road?
This vote is going to be a little bit of a vote of strange bedfellows. I think what you're going to see is at the end of the day, there's some members that are going to allow perfection to be the enemy of the good. All of us, I think, would like to see us get our true fiscal house in order in the United States. This bill is only a step in the right direction, but it's a step in the right direction. It's the largest spending cuts that we're going to ever see in the United States of America. It has work requirements. It helps workers get back to work, and it does all this without raising taxes. And so at the end of the day, there's some people that would like to see a perfect bill, but I think if we have a good bill, you got to vote for it.
Congressman Jim Garrity in the Washington Post had a brilliant half paragraph yesterday which said, look, the Republicans have a narrow majority in the House. Can you expand that power in Washington with President Trump after this budget debate? Can you get there with Donald Trump in November of 2024 to move beyond a narrow majority in the House?
I think what we're going to see now to the election in 2024 is a lot of voices coming to the table. And I think the one that's going to be successful is the candidate that's going to talk about the future of the United States of America, about how we're going to grow the economy and address the fiscal situation that we're in. We're going to have a number of voices at the table. I don't think that's a bad thing, because I think we need to dramatically change course in Washington, in particular following 2 years of dramatic increases of spending.
A lot of people talk about the real discussion being entitlements and whether Social Security checks are going to have to be reduced, whether Medicare and Medicaid are going to have to receive less funding. Are you putting those things on the table in your discussion about further fiscal restraint?
In this bill, we're only really dealing with 11% of the federal budget, and dealing with 11%, we got $1.5 trillion of savings for the American people. But you're right, at the end of the day, it's the entitlement programs that are driving costs higher. This is going to be an opportunity here to bring Democrats and Republicans to the table to address those programs and truly protect, in particular, Social Security and Medicare for generations to come. But that's going to require a bipartisan approach of folks coming to the table, encourage of candidates who are running for president in 2024 to talk about the reforms that are ultimately going to be needed.
There's a large question around whether that will actually happen, and we've been having it with a lot of cynicism. I'm sure you have your own with insight from inside the Beltway. Wendy Schiller of Brown University was on the show earlier, and she said Kevin McCarthy will remain Speaker of the House simply because the Democrats will back him if the Republicans won't, because at least it will be some sort of cohesive voice that is better than the alternative. Does that concern you, that Kevin McCarthy will remain Speaker, but perhaps only at the behest of Democrats who are concerned about the alternative?
I actually disagree with the analysis. I think Kevin McCarthy will remain Speaker with Republican votes. I actually don't even think you'll see a motion to vacate. We had a robust family conversation last night into the late hours of the evening talking about this legislation. And while it's true, there are some Republicans that would like to see a better bill. They think that they could get a perfect bill. At the end of the day, I think everybody in the room recognizes that this bill is a step in the right direction, and they're appreciative of the Republican negotiating team that moved the ball forward. You got to remember, we started with the president saying that he was going to refuse to negotiate. He put his head in the sand. He went to Delaware, went off to Japan rather than negotiating. And at the end of the day, we came back with $1.5 trillion in savings.
You sound like Paul Ryan on an off day. Come on, Congressman, come on. What I'm hearing in the zeitgeist right now from Anne-Marie Horton is the Democrats are taking a victory lap because they pretty much got what they wanted. Moderate Republicans like you are saying, okay, let's get this done and move on. And you got a bunch of people trying to block this and shut down the government. I got to go back to the fact you lived Paul Ryan's decline as Speaker of the House. I want to go from Boehner to Ryan to McCarthy. What does the Speaker have to do now not to be Paul Ryan, not to be John Boehner?
I think actually the Republicans are quite unified in the House right now, and I think that shows when we passed the Limit, Save, Grow Act. Many people across the United States underestimated the ability of Republicans to come together and unify and pass a bill. In fact, President Biden didn't think we could do it either. That was part of his negotiating tactics. And at the end of the day, we came together. I think the Republican conference in the House is quite unified to address the spending challenges that we face.
But, you know, the Speaker, okay, I'll go with that. But the answer is, John, the speakership here is under real threat, and it comes up suddenly. Did it come up suddenly, Congressman, for Paul Ryan? Was everything fine, and then boom, you're his aide in office, and all of a sudden, boom, he's under threat by these Republicans?
I was working in the private sector for quite some time, so I wasn't on Capitol Hill for about 20 years before I ran for office. But I think what you see is at the end of the day that these things can rise on occasion. But if you talk to Republican members, we're unified in the House of Representatives. I think everyone recognizes that this is a good bill. There's just some conservative and Republican members that would like to have a better bill. That's not the bill that's on the table.
Congressman, I'm just a spectator and watching this play out for a long time, both within the United States and abroad as well. And every single time we get into this debacle, we just raise the debt ceiling again and again and again and again. Whether that's a Republican president or a Democratic president, it's the same outcome. We raise the debt ceiling. Brian, you heard JP Morgan's Jamie Dimon come in from the break there saying, I wish one day they'd get rid of the whole debt ceiling thing. Why do we still have it? And isn't it somewhat embarrassing for the president, whether Republican or Democrat, to go abroad to places like Japan, for the G7, to try and lead the global effort on a whole bunch of issues, to then be looking back and have this EM-type debacle playing out at home?
In a period of time of divided government, there's actually few opportunities to negotiate the spending reforms that are needed, in particular a period of time when executive authority has grown so dramatically. In this bill, we actually address the fact that the president tried to dramatically alter student loan payments. That never went through Congress in the first place. Unfortunately, based on executive overreach, what we have is so few opportunities to get spending under control, where the executives, both parties, are absolutely right, continue to spend money through executive action. And this negotiation allows us to actually bring the president to the table and have a conversation about how we're going to get spending under control. And I think, again, at the end of the day, this is overall a good bill moving us in the right direction.
Yeah, the one bill aside, Congressman, don't you see where this is going, though, that ultimately, and we're out of time, so if you want to continue this conversation, by all means, come back another time. It just feels like we're in the process now of deliberately manufacturing crises to do exactly what you just explained, and at some point that's going to erode the confidence in this country and potentially the US debt market too. So we've got to leave it there. Congressman, if you want to continue, happy to do that another time. Congressman Brian Steele there of Wisconsin, Tom. These are big issues, and they're not going away anytime soon. Let's be clear about that, no matter who wins.
I agree. I'm trying to get a measure of Speaker McCarthy's risk as we move forward here. He had a good day yesterday.
Hornback and Morgan Stanley up in the next hour. Jill Carey Hall of Bank of America, Jean Balvin of BlackRock, all of that coming up in about 30 minutes.
top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China, nothing comparable to that ever. That's why the heat records are broken every year, and we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Bloomberg Surveillance, Lisa Abramowitz and Tom Kane. Mr. Farrow, in preparation for the next hour. In the next hour, Lisa, you may see, I'm getting it up here, West Texas Intermediate, are you going to see a 66 handle in the next hour? $67.12. $66 a barrel, Lisa. I mean, that's where you got to go long oil again. I mean, you know, a couple barrels in the living room.
How many people have come on the show and said, you know, it's just a technical trade. This isn't actually something driven by fundamentals and a lack of demand.
Can't tell that to Riyadh this morning.
But that's really the issue. And all of a sudden now you have the likes of Bob Michael and many others coming out and saying the declines that you've seen in the broader commodity sector is telling us something. It is screaming about a slowdown that is coming.
Yeah, Bob Michael featuring the Bloomberg Commodity Index, which is the old UBS index, legit math to say the least. Right now, before we get to Blarina Urici with T. Rowe Price, Michael McKee's going to give us a brief here without 8:30 data. And I got to go something, John, Michael, you lectured me on years ago, which is pay attention to JOLT survey. Are we finally seeing the labor market crack?
Well, we hope so. We saw a decline in the number of job openings last month. When we say last month, it's 2 months ago. So this is somewhat old data, but we are expecting another decline this time. And that would be good news for the Fed, which is thinking that the high level of job openings is one reason that we're still seeing a lot of pay increases for workers because it's hard to find them. But if it continues to go down, that should take a little pressure off. Still a long ways to go till we get to the pre-pandemic level of around 6-7 million.
We've been talking this morning about Loretta Mester's comments in the Financial Times about going raising rates one more time before pausing or taking a breather. Is that becoming more of a consensus now that there hasn't been a fuller shakeout in the smaller bank sector?
It does seem to be more of a consensus, although the voters, the Fed voters who have spoken are about evenly divided. I think what you're going to see is Friday and then the CPI report, Friday's jobs, of course, and the CPI report on the 13th are going to be dispositive. So I wouldn't go to the bank with what's in the WIRP Fed Funds Futures argument that there's a 65% chance or so of a rate increase, because that could change depending on the data. But it does look like most people at the Fed leaning in that direction now.
Before we let you go, I do want to get your view on the debt ceiling debate, not necessarily the politics of it, but with respect to the economic ramifications. And one thing that we haven't talked about that much is the student loan repayments that have been flagged will have to start in a couple of months' time as a result of this deal. People are saying this will eat into disposable income, eat into disposable spending in a way that hasn't been accounted for in the economy. How much are you hearing that from economists?
Oh, you're hearing that a lot. It's probably the biggest thing in this debt ceiling package that would affect the economy, because the overall numbers are pretty small, but we could see a compressed period of declining domestic spending if people who are spending that average $369 a month payment on something else right now have to start sending it back to the government lenders. But it's also been pointed out that when they ended the supplemental food stamp program and when they ended the supplemental child care tax credit, we thought that would happen and the effects were much smaller. So it is certainly possible that it doesn't have a major impact on the economy right now. And of course, it'll be a little hard to tease out in terms of other things that have been going on, the Fed raising rates, et cetera. But it will be something to watch.
Michael McKee, thank you so much. The JOLT survey out, I believe, in the 10 o'clock hour. Bluerina Urici joins us right now, U.S. economist T. Rowe Price, here on the shifting tides of the American economy. Just as a basic idea, do you have any handle on second quarter GDP yet? I mean, everybody's waiting on recession, but what's a T. Rowe Price call on where we are in growth right now?
So right now it feels like we're going to get another quarter of positive growth, at least the components that I take more signal from, which is consumer spending and personal consumption expenditure component. We have had a lot of volatility in the inventory data and net trade, but overall, when you look at consumer spending in the U.S. economy, that has been holding up. And actually, a lot of people expected this shift in spending from goods to services, but we actually are continuing to see in the economy that both components remain strong and the U.S. consumer goes out to spend.
One of our themes is a return to American exceptionalism. Country by country, they seem to be slowing down, widely anticipated by IMF and frankly by you. At T. Rowe Price, is America the place to be because of economic growth?
Well, I think we saw that last year, and I think that theme continues, that the Fed was able to increase interest rates faster and sooner here than other central banks because of the resilience of the economy. The U.S. consumer has been strong. I do think, however, that the direction of travel for the second half of the year is one where a ton of headwinds are gathering momentum. So the U.S. economy is going to slow as well, and we're already seeing signs that the labor market is starting to cool down. All those things, I think, are going to play out such that the U.S. will not be as strong in the second half of the year as it was in the first half.
Earlier this morning, Wells Fargo CEO Charlie Scharf was speaking at a conference, and he talked about credit card spending being up 10% so far this year. Debit card spending is about flat, but people are still out there spending in a significant way. He also went on to say that credit quality remains strong and that the demand and the use of some of these instruments is much stronger than expected at this point in the cycle. What are you looking at, Bluerina, that points to something that is softer, that is perhaps an inflection point to a lower growth rate?
So I think a lot of what was happening last year was the labor market was adding jobs and aggregate hours and aggregate income was growing very fast, even faster than inflation. I know when you look at average hourly earnings, that was being surpassed by the rate of inflation, but the payroll proxy that I looked at was not. Now that payroll proxy has been declining because of the pace of job growth is down, but more importantly, hours worked are declining faster than employment growth. So I think this is important. It's an important factor to watch. The other one has been the excess savings story. Remember that we were talking a lot about it at the just as the pandemic ended, whether that was a wealth effect or it was going to be spent by consumers. Turned out last year that consumers continue to spend that excess savings buffer, and I think that's going to run out at the end of this year. And both of those, then you add the fiscal impulse, which is only slightly negative, but it's adding to this momentum that is dragging the economy down. All those factors make me less optimistic about the U.S. consumer later in the year.
Less optimistic isn't exactly the gloom and doom that we're hearing from some people, and I am wondering whether you think that the momentum that we currently have, based on all these indicators, is enough to avoid recession and makes a recession improbable just simply because there still is this savings. There's
no situation. Labor market is key. We'll get the JOLTS data, as you mentioned, later today. Once enough. could be that we get the softening in the labor market that we need purely through closing of vacancies, which is something that Governor Waller has been discussing since last summer. And I do think that what we've seen so far seems more consistent with a soft landing in the labor market.
Ballerina, we're talking about lower yields. We heard this from Bob Michael of JP Morgan earlier, price up, yield down, and there's a raging debate about this. You're in an interesting seat at T. Rowe Price, managing gazillions of dollars here. Is the overarching theme linking your economics with your portfolio managers, price up, yield down in bonds?
So I think lots of factors have been affecting yields in recent days, but zooming out, looking at the 2-year, for instance, from September to date, it's been in this range of 4 to 4.5, I think, for most of the time. What is this telling us? I think the markets, in a way, is buying the story that yields will be higher for longer, but probably we are quite close to the peak in interest rates. And so from here, I don't think there is that much upside for yields.
I mean, Lisa, I think this is just a profound idea, and that Bullard and others are talking about higher rate regimes. We've got to get to here, and others. I mean, the calendar's moving forward. What Ed Hyman says, or Bob Michael says, or what we hear from Ballerina is something in January or late last year. They're now saying we're going to compress this into 4 or 5 months. I find that extraordinary.
And how much does this have to do also with the China reopening? And Ballerina, I do want to just end there really quickly to get your thoughts on how much suddenly the disinflationary push that people are talking about accelerating stems from a China, which the reopening really doesn't seem to be as powerful as many people expected it to be.
I think the China economic growth story looks very different than it did 10 years ago. I don't think they're going to drive economic growth through investment as they did, and I think this has repercussions for global inflation and global demand on commodities, and I think we're seeing that play out.
Ballerina, thank you so much. Ballerina Arrucci with us with T. Rowe Price here on the American economy and the raging debate forward. Maybe a softer tone that we heard from Bob Michael. Are we lucky on this day of China data? I mean, we say we're lucky, but you know it's our team doing it. You and I are taking the surveillance nap, and the team is working 24/7. Bill Lee with us earlier with all of his IMF cred. And then having Leland Miller come up is just exceptionally fortunate today.
To understand the on-the-ground reality behind the pretty disappointing PMIs that came out, how much is this just manufacturing not keeping up and services continuing to chug along? How much, and this is really the key question, you kept bringing it up and I think it's a good one, is there really an inability or a complete reluctance by the Chinese government to offer up some stimulus in some capacity?
I'm in the camp here. They don't have a choice because of the mandate of the kind of regime, the kind of politics they are. They've got to keep people employed. Someday I'll be wrong on that, but they got to keep people employed.
From a global perspective, how much that bleeds out into the global economy, though, is as opaque as the reopening has been and as the entire pandemic economy. And this is one of the reasons that's sort of feeding into the uncertainty that you get with a lot of economic views.
And the economic views is, again, and I think of Ed Hyman way out front here on calling for a lower rate regime. Let's remind ourselves the 10-year yield, 3.67%. Where's it going to be Labor Day, Bob Michael? Where's it going to be end of the year, Ed Hyman? And on you go to price up and yield down as well. Coming up, the conversation of the day on China. We had William Lee with us of Milken earlier. Leland Miller of China Beige Book. Must listen, must watch for Global Wall Street. This is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Jamie Dimon says J.P. Morgan Chase will be in China in both good and bad times, remaining committed to doing business in the Communist Party-ruled nation. CEO of the biggest U.S. bank also says he doesn't foresee a decoupling between the West and China.
Over time, there'll be less trade. You know, it'll take years for these things to take place, but it won't be a decoupling. And the world will go on.
Dimon's remarks come as China-U.S. relations are at their worst in decades. Photos obtained by Bloomberg show Elon Musk at a restaurant in Beijing. The Tesla CEO met with China's Minister for Industry and Information Technology. Now, Musk is expected to tour Tesla's Shanghai factory later today. South Korea's spy agency says North Korean leader Kim Jong-un may be suffering from a sleep disorder. The National Intelligence Service says North Korean authorities are intensely collecting overseas medical information for top-ranking officials with insomnia, including details on medications used to treat it. North Korea has also confirmed that an effort to launch a military spy satellite into orbit failed. The official news agency reported a rocket crashed into the Yellow Sea after losing propulsion in the second stage of the ascent. The launch initially prompted missile alerts in both Japan and South Korea. Pyongyang says it will attempt another launch soon. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it's very different, and it's not something people have had to operate in for a long time.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. The markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg. Top experts. Great questions.
When we do business in the country, and we do business in 100 countries around the world, we are there for the citizens of the country. And we're there, hopefully, through good times and bad times. We tend not to leave. If you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's going to continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China's obviously going to do what they think is good for itself.
Jamie Dimon in Shanghai with our Steve Engel. Great interview there on the optimism of banking forward on the Pacific Rim with the head of JP Morgan. A lot of conflicting trends today. Lisa, Neil Dutta, who has been very optimistic and correct on a non-recession America, looks at what Bob Michael said, and Michael says rates are coming down, inflation will come down, and what that means is the income we make will be more valuable. Inflation-adjusted incomes will expand. That's been a core optimistic foundation for Mr. Dutt of Renaissance Capital.
Yeah, return of the bond boom, and this is really the key question. I mean, we talked about Jean Bovin going over of BlackRock with John in the next hour. He takes the opposite view, saying that longer-term bond yields are not going to go down as much, and this really goes down to: do you believe that inflation is sticky, or not? And that is one of the biggest debates right now where there really is not a consensus.
If you're part of Global Wall Street, and particularly if you're part of everything that has to do with investing in America, here is your Chinese conversation of the day. William Lee was with us earlier with some real caution off of difficult Chinese data this morning. Leland Miller flat out disagrees. He is the co-founder, chief executive officer of a China beige book with prodigious data analytics of China. Leland, you're more optimistic. What is the data you see in China that leads you to Pacific Rim optimism?
Yeah, optimism is a strong word, but I think people have gotten too gloomy. And I say this because, there was a ebullience earlier in the year that there was going to be this explosive Chinese recovery. It was going to happen fast. It was going to happen a lot like America's. That was never in the cards. China had to get over COVID. So, January, February, even March was mostly taken off. So we're starting to see, April and May, whether there's going to be much of a recovery. Now, some of the latest data have been bad. Some of the stuff that we're seeing has been better than what the government's been putting out. So we're not seeing the worrying falls that have perpetuated this gloom. Stock market falling and economic data being weaker than expected has created a sense of gloom in markets, and we're just not there.
Dr. Lee talks about a dearth of innovation, which comes from a more strident autocracy in Beijing. No question about that. Given the changes that you see off the party Congress, is this a Chinese leadership that could still use traditional monetary and fiscal stimulus to goose the economy?
Well, the economic model still relies on that in part. They're just a lot more restrained and, constrained from being able to do it in the way they did before. So, yeah, I think that there are elements that, as things get worse, they're going to be under more pressure to stimulate. And look, I think the mistake right now is people think they're not stimulating. We've seen a lot of policy support already this year. We're seeing rates sliding. We're seeing loan rejections falling, which means the government has been more permissive in credit provision. So it's not nothing. It's just that they haven't resorted to the big infrastructure build out. They haven't been building in order to stimulate growth. I think they want to stay away from that, but they are being supportive on the monetary side. So policy support is there. It's just not what it was in the old days.
Leland, you said that people have been too gloomy on China. Where specifically are people underestimating how much strength there really is?
I think there's two places. The first is, everyone's shaking over this latest manufacturing PMI. When we look at our manufacturing data, we're not seeing gloom in terms of orders. Domestic orders are okay. Foreign orders are okay. They're weaker to the U.S. and Europe, but they're stronger to Asia. And then when we look at this consumption recovery that everyone's been expecting but hasn't seen, we're starting to see elements of that. The problem before has been it's been uneven, and you've seen sort of travel and hospitality go up, and then they go down and something else goes up. We're seeing better data in May than we saw in April, which is better than March. So, we're seeing not the recovery that so many people unrealistically expected earlier this year, but we're seeing a recovery that's there and defies a lot of this total pessimism in markets over China's economy.
How much of that recovery is in domestic spending and not international spending? I'm basically an economy that is contained within China and doesn't necessarily percolate out in the same way that traditionally Chinese economic activity did.
Well, I think that's exactly the positive story, that most of this is coming from, domestic demand. You look at our inflation gauges, we're seeing strengthening prices. We're seeing strengthening jumps in all our inflation gauges across the board, which are showing more domestic demand. Our domestic orders are up. Look, it's a relatively weak international, global economic environment. Manufacturing in China has been going like gangbusters for years, so we're not expecting manufacturing to lead. But manufacturing is doing okay, and we are seeing retail and services do better each and every month. So as long as you calibrate your expectations, this is not the massive disappointment that everyone's making it out to be, at least yet. We need to see the data through June, and then we're going to be able to make a better call on this.
How does that affect your longer-term view of slowing growth? We were talking with Bill Lee of the Milken Institute, formerly of the IMF, and he was saying he sees potentially below 5% this year, but then going down to a 3% kind of level on an annual growth perspective. Do you kind of take the same kind of view?
Absolutely. I'm glad you pivoted to that because, look, this is a cyclical bounce back. You're seeing there's a lot of reasons why 2023 growth will be better Then 2022, COVID zero's off. We've got a better base of comparison to work off of, but it doesn't change the long-term story. And the long-term story is of a significant structural slowdown.
Right.
So we've been talking about these numbers, 2 to 3% for years and years and years, and they've been scoffed at. But now people are taking them seriously.
Leon, when we see the unemployment discussions, millennials 20%, whatever. Take us away from the Pacific Rim. Take us away from a quarter of a mile away from the Mandarin Hotel in Hong Kong or whatever fancy place I'm going to stay. What is the people's reaction in China to unemployment?
Well, look, I think the major issue is that with slowing growth, you're going to need to be transitioning jobs from the traditional ones to new ones. And there doesn't seem to be a great long-term plan for doing so. So, the question is, what does the Chinese government care most about? You're exactly right. They care about jobs. They care about employment. They care about stability. Yeah. So they're going to have to be providing for this. You have to create an economic growth to be able to do this. If you're just battening down the hatches and saying focus on semis, it won't do it.
So at the margin, are they competing with Vietnam or a more prosperous Korea? I mean, on a labor economics basis, what's the shortest path to success for Beijing to create marginal jobs?
Well, they think they're competing with Korea and Japan. They're still competing a bit with Vietnam. The model is in transition right now. So the question is, are you able to make that transition without social strife hitting along the way? And look, this is a very dicey proposition. This is a very hard thing to do. So if you no longer have high levels of growth and you're no longer relying on property build-outs and infrastructure build-outs to drive growth, you're trying to transition to a sort of a higher level way. And look, this is a very dicey proposition. This is a very hard thing to do. So if you no longer have high levels of growth and you're no longer relying on property build-outs and infrastructure build-outs to drive growth, you're trying to transition to a sort of a higher level, economy. It's not at all clear they can do this without problems along the way. So this is why I think people are worried about China in the medium term and long term, and certainly we are.
Leland Miller, thank you so much. Just fabulous here. Great to have you on China Beige Books. Leland Miller, and of course that dovetail with William Lee of the Milken Institute makes for good China analysis. Today we say thank you to Stephen Engel in Hong Kong, his conversation in Shanghai with Jamie Dimon of J.P. Morgan. Lisa, I'm watching here, and it makes for good TV theater, and I've gone down in flames. I need a $66 print on West Texas Intermediate. I didn't get it. I got the 67.06, but I don't even know how to go OPEC plus here on this. I mean, I don't know what the supply microeconomics is for Riyadh here to boost the price.
You know who does know? ChatGPT.
Really?
There was an article that just came out.
Did we hire them?
Yeah, we did hire them. Evidently, hedge funds are increasingly hiring ChatGPT to handle all the grunt work, which I think is pretty much on brand. I mean, that's what I'm hearing from people who are in school.
Can I go mathy here?
Please.
For 30 seconds? Take the longest series I have, which is Saudi Light. It's a Arabian Saudi Light series back to the 1950s, pre-Nixon and all that. And I looked at the collapse of 1986 on a log chart, and you compare that move to now, and it equates out to $40 to $41 a barrel. So we're basically halfway there to a 1986 kind of feel and a plunge in oil. We're nowhere near that agony yet, but there it is.
Big question, how does Riyadh handle Russia? How does Riyadh handle Moscow, which is pumping a lot of oil, perhaps above the quotas and the agreed upon discussions?
We're going to let Will Kennedy and our world-class team on hydrocarbons discuss this. It's certainly a theme here into June. Tomorrow on the program, sell in May and go away. The Bramo Report. We'll have that for you completely. Stay with us through the day. This is Bloomberg Surveillance.
The names that move markets are on Bloomberg.
The regional banks have been under some stress, but I think the banks that have failed have had some very unique characteristics. What I see is a banking system that overall is well capitalized, still has very solid earnings, but we're monitoring the situation very carefully.
Nobody covers business like Bloomberg, your global business authority.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy. David, art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live, and it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of work, pre-work, before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. You know, lots of testing, lots of thinking about what could go wrong, lots of research. You know, when I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of, like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Whatever happened to the month of May, closing out the month with some big equity market gains on the NASDAQ. From the month, for the session, we're down about 0.5%. A bit of a weakness, counting it down to the opening bell. The countdown starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, the debt limit deal heading for a vote in the House. One more Fed official pushing for one more rate hike as China confronts a deeper manufacturing slump. From New York, we begin with the big issue, a spat Wall Street is hoping it can forget about.
I'm not sure what in the bill people are concerned about.
I haven't seen the text. You know I'm not a big fan of in principle or frameworks.
Not one Republican should vote for this deal. Not one.
It's our expectation that House Republicans will keep their promise and deliver at least 150 votes.
It is a bad deal.
We should have taken care of this months ago. Everybody has an opportunity for their own opinion.
No matter what happens, there's going to be a reckoning about what just occurred unless we stop this bill.
This agreement is the responsible, prudent, and very necessary way forward.
Yes, I'm confident we'll pass the bill.
The debt limit deal struck by the President and Speaker McCarthy heading for a vote in the House after clearing a key procedural hurdle. Investors now hoping we avoid any needless political drama, refocusing minds ahead of next month's central bank decision. Cleveland Fed President Loretta Mester pushing for another hike, telling the Financial Times, "I don't really see a compelling reason to pause. I would see more of a compelling case for bringing rates up." Bank of America's Mike Gapen calling it a close call. Even if the Fed skips June, it will keep July in play. He says the data so far supports further tightening. The Fed, of course, contends it is data dependent, whatever that means. The calendar for that data looks a little something like this over the next 2 weeks. And Citi's Andrew Holdenhorst is setting the bar for another move, saying, quote, 200,000 new jobs in data out this week. Another 0.4% month-on-month core CPI reading on June 13th would further cement a June hike. JP Morgan's Jamie Dimon saying they can go further.
my simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause, but I do think it's possible they're going to have to raise a little bit more.
Let's get to the Bloomberg team. AMH down in Washington, D.C., alongside Kelly Lyons. AMH, I said at the start, this is something Wall Street wants to forget. Do you think we can achieve that a little bit later?
Yeah, Wall Street certainly wants to forget it. To be honest, Jonathan, since the Treasury Secretary came out with her first letter about using extraordinary members since January, I think all of us want to forget and put the debt ceiling debate behind us. It does look like the path is clearing for this to move through the House. You're really going to want to pay attention to the numbers, though. Speaker McCarthy really wants to get a majority of his Republicans over the finish line on this. What we're hearing is about 150. A lot of this will also show with how strong his speakership is. And then, of course, it has to go to the Senate. Now, everyone thinks it will pass the Senate, but it doesn't mean it's going to be an easy process. You're potentially going to have a number of senators come up. They're going to want to make amendments. Lindsey Graham, we know, he is one that wants to see higher defense spending because he's worried about the impact of inflation. You have others like Mike Lee of Utah saying it's not enough cuts. But by and large, it looks like this is going to be able to get passed before, or at least signed by June 5th. When the Treasury Secretary says that's the hard deadline for the debt ceiling.
Kelly, get through the House, then onto the Senate. Any problems that you foresee?
Well, as Anne-Marie was just suggesting, you could see any one senator hold things up, whether that be Senator Mike Lee or potentially Rand Paul, who wants to force a vote on his alternative plan. So the procedural hurdles are very large because it does require unanimous consent to actually accelerate the process, which does risk bumping up or maybe going over that June 5th deadline. So default isn't entirely off the table, even if we have the House passage today. Now, on that note, of course, if we saw a default happen, something that has never happened before, that very likely would change what the Fed does in 2 weeks' time. If we don't, though, and this deal goes through, what we hear from economists by and large is that it doesn't have a massive impact on the macroeconomic outlook. You may see at the lower end of the income spectrum because of the restart of student loan payments and some of the stricter work requirements for entitlements impact there. But overall, we're talking just a 0.1% knocked off of GDP in fiscal year 2024. So unlikely to really change the growth picture for the economy. And then, in theory, for the Fed. The one thing we do have to consider here, though, John, something we've talked about at length as we've gotten closer to the actual debt ceiling being raised, is the liquidity implications, the stresses that may cause in a banking system that already isn't the most stable at the moment.
It's a big question. Kayleigh, thank you. Alongside Anne-Marie, ahead of that vote a little bit later down in Washington, D.C., going into the opening bell about 25 minutes away. Equity softer here, negative by 0.5%. Joining us is BlackRock's Jean Bavin, Morgan Stanley's Matthew Hornbeck joins us too. John, I want to start with you and go to that quote from Andrew Hollenhorst, the City, who says 200,000 on payrolls Friday. CPI, June 13th, month-over-month core 0.4. We get those two things. He says hike is on June 14th. Do you agree?
Well, I'll just start by saying it's pretty remarkable that the last meeting was about engineering this pause that was widely expected. And I think we're seeing the playbook that we've seen in Canada and we've seen in Australia, which is like an attempt to pause, but quickly gets derailed with the need for further tightening that becomes obvious. So I don't have a strong view. I think the most important thing is that they're not cutting anytime soon. That was the biggest disconnect. That disconnect is disappearing now. Much more important than whether they hike. But I think the odds of hiking now are reasonable.
President Mester has a strong view. I don't really see a compelling reason to pause, to the Financial Times. Matt Hornbeck, do you see a compelling reason to pause?
John, we do. Our chief U.S. economist, Ellen Zentner, does not think the Fed is going to deliver a hike in June or July for that matter. But I do think that there is a compelling reason to pause. And that reason has already been articulated by both the chair, Governor Jefferson, which is the idea that monetary policy operates with lags. This is something that is not always immediately obvious in the sense that you don't get this immediate transmission from a rate hike into the real economy in real time. It takes a period of months or quarters and sometimes more than a year. And so I do think that there is a very real reason for the Fed to pause here and see how the economy evolves.
Matt, they seem to hate that word, though, pause, because they seem to believe, and I think perhaps some of us agree, that it implies cut is just around the corner. Matt, how do you think they're going to manage that?
Well, I mean, they've already tried to better define the word pause by entering the word skip into our lexicon. I mean, like when I think about the word pause, I think about watching a movie and I push pause to go get some popcorn. I don't come back to the movie and then rewind it. You know, I just push play again. So I think the word pause is plenty descriptive. But yeah, the history of the Fed suggests that when they stop hiking for any length of time, the next move is a rate cut.
Jean, one key feature of your outlook for the whole of this year, you've pushed back against these cuts big time. And when it comes to the equity market and risk assets, you do not think the Fed's going to bail us out this time around. Is that, Jean, because you still believe that this inflation backdrop is going to be stickier for longer?
Yeah, I mean, you know, I think we're going to end up eventually getting close to target on inflation. Where I mean, I don't have a strong view on when. I don't think it's going to be in 2023, and it won't probably be in 2024 either. But we're going to head towards that. But what is fundamentally different from what we've seen for the past 40 years is that we're in a world where we're going to see ongoing inflation pressure underneath that will require essentially a tightening bias to be a structural tightening bias to be at play, which is the opposite of what we've been saying for the last 40 years, where there was like a structural easing bias. I think that's the fundamental difference. And as a result, I think that the biggest part of the playbook, usual playbook that doesn't apply this time around, is that they won't come to the rescue easily if the economy tanks. The economy slowing, contracting is part of the recipe, and that's the part, yeah, we've been pushing pretty hard throughout the year. I think the market has moved now closer to what we think is in line with what's going to happen. But yeah, no rescue, I think, is the starting point.
Jean, tell me what that means for portfolio construction. And help me understand what that means for my allocation to fixed income. Now, you and I have talked about this a lot over the last few months. Fixed income, for now, for once, compared to the last 10 years, now offers me some income. What I'm trying to work out, and it's something that you've tried to answer, is whether it will offer me that inverse correlation to risk, that diversification within the portfolio. Have you got your doubts about that further out along the curve?
Yeah, so just to start on the income piece, right? So I think the fact that we don't see a rate cuts or an easing cycle coming, I think bolstered this case of income is real. Short duration fixed income is very attractive, continues to be. I think we're going to be able to clip some of these income for the foreseeable future. Now, the Fed not coming to the rescue, to our mind, has been the key catalyst for how bonds and duration has played a balanced role it has played since 2000. It was because of this Fed central banks coming to the rescue whenever needed, taking the downside, which in our view is, as I said, is not happening, and that calls into question how much faith you should have in duration and long-term bonds playing their balanced role. So we're skeptical. We think there still is a pretty entrenched playbook in people's mind, markets participant, and when they hear recession, there's a bit of movement in yields lower. So I think that can play as a trading kind of tactics or a very short horizon kind of tactics that can continue to play. But in terms of portfolio construction, longer term, I think the balanced properties have been weakened in this environment considerably.
Matt, do you share that skepticism?
I guess I'm less sure, John, myself. I don't think we've had a long enough bout of high inflation to say that the next 20 years we're going to see inflation persistently above target, and therefore the Fed is going to have to act with a bit more caution in terms of their reaction function. I just don't think we've seen enough data to clearly say that at this point. So I would say I'm reserving judgment on that one at this point.
Bob Michael at JP Morgan Asset Management out this morning looking for 3% right across the curve through this summer, looking for cuts in September. That's pretty bullish on treasuries. The 10-year right now, 360-ish. The 2-year at the moment, 440. We'll keep building on this. Jean Bavin, Matt Hornback are going to stick with us, luckily, fortunately. Going into the open in about 20 minutes away or so. Equities near session lows, negative 0.5%, with some movers going into the open. Here's Abby.
Hey, Don. Well, we are looking at the S&P 500 heading toward its first down day in 4 sessions, potentially. So we're looking at lots of laggards. First, though, let's take a look at American Airlines, up nearly 3%. This after the airline did boost their second quarter EPS outlook, their capacity. They held that view. One measure of revenue is a little better better on strong demand. To the downside, though, NVIDIA, after its best three-day rally since 2002, up more than 30% over that time period on that monster outlook raise, down today, down 1.7%. But clearly the big plunger here, John, advanced auto parts heading to a possibly record decline, down 29.4%. They cut their full-year profit view by about 40%. They slashed their dividend by 80%. It's going to be interesting as the day progresses to find out more of what's behind that big revision, frankly.
Abby, thank you. Coming up on this program, Jamie Dimon of JP Morgan weighing in on China.
China's obviously going to do what they think is good for itself, and business might be a positive attribute, but national security will trump all other issues.
The latest data disappointing once again. That conversation up next.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
This is Bloomberg.
If you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's going to continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China's obviously going to do what they think is good for itself, and business might be a positive attribute, but national security will trump all other issues.
Jamie Dimon of JP Morgan speaking exclusively with Bloomberg on China and other issues as well. This was a consensus call for the year ahead. It was get overweight all things connected to this story in China, the reopening, better economic growth, and then this happened. PMIs overnight, manufacturing 48.8, the estimate 49.5. Services holding in, but manufacturing disappointing. And as this dropped at about 9:30 Eastern time yesterday, this dropped too. The euro dollar breaking down to about 106.85 on the screen right now, negative by 0.5%. And some measures, some Chinese indexes, equity markets, showing the equity market in China in a bear market. Mike McKee, that's not the way this year was meant to go.
It is not the way this year was meant to go, and there's a lot of things going on. Jamie Dimon maybe underscored it when he talked about uncertainty, because there is the international diplomatic effort by the United States to sort of isolate China technologically, and there is also the Chinese effort to clamp down on its own economy and to become more centrally planned. And you can see what's happened, John was just talking about with those PMIs, especially manufacturing, falling far are short. Now, the hope was that a lot of people would spend money coming out of the pandemic in China, and we did see an initial pop in services, but those have rolled over as well. And overall, what you're seeing is a decline in what they think is going to happen. The country put out a very conservative 5% growth rate. Economists still think they're going to get 5.5 for 2023, but the 2021 GDP came up 8.4%. And in the years before the pandemic, they were regularly in the high sixes. So China definitely slowing down. That's having an impact on the world now. We are seeing demand fall for imports into China, particularly for commodities, which could have a big impact in the United States and Europe in terms of inflation. You can see there what's happening with the metals for copper and for iron ore breaking down through some key levels as Chinese demand drops. And so we are looking, John, at a situation that is going to have different impacts on the global economy, maybe bring down inflation, but also maybe bring down growth a little bit.
Mike McKee, thank you, sir. Pleased you brought up commodities, 68 on WTI. Thank you, Mike. We're down by about 1.6% this morning. Brent crude in the low 70s at 72. We're negative 1.4% there. Jean-Bavin, Matt Hornback back with us. Matt, this wasn't the way this story was meant to go this year. We had the reopening of China. Global growth was meant to get a boost. What do you make of the incoming information so far, Matt?
Well, I mean, John, it certainly hasn't been supportive of these consensus views. I mean, our economists have also been quite bullish on China, vocally so. But, you know, I think ultimately what they're counting on at this point is policymakers in China to take a more serious approach towards easing conditions to encourage growth to rebound as we make our way through the second half of the year. So that remains the view, but certainly the data have been surprising to the downside.
And Matt, this market's just been beating up consensus views coming into 2023. Don't touch tech, it's ugly. Had a bad year last year and then tech ripped. Similar story with the US dollar. The US dollar gets short, the rest of the world's looking better than the last month or so happened. Matt, where are you in the team now in the US dollar?
John, well, so we came into the year not liking the U.S. dollar, in part based on the idea that China's economic recovery would be real. But, you know, what we did a couple of months back is we pivoted to a long dollar stance, and we maintain that today, John. Positioning at the initiation of our long dollar view was very bearish, the U.S. dollar. That positioning has changed a bit over the course of the past month or so, but we remain convicted that the U.S. dollar has further to run higher, and certainly China disappointing has been helpful to that view.
What am I going to see first, Sean? 110 on euro dollar or back to parity again?
I think good question. I don't have a strong view on the direction of the euro dollar. I think maybe there's a bit more weakness that can come through. But to your point on the China story, I'm just back from 2 weeks touring the region, and I think we used to say that the farther away you are from China, the more bearish you are. And I think one thing that is unusual this time is I think it's the opposite. The closer you are, the more bearish you are. I think there's an animal spirit kind of issue really playing out. This is the wobbling we've seen over the last couple of weeks in the data, and that's the risk aversion from a Chinese consumer is very material. So we are still constructive on China and the region because of the very different backdrop in terms of policy that you can see there. So there's an ability to respond. They're reluctant to deploy it, but there's the possibility to do it. So there's a floor. But yeah, I think that broad thesis is more questioned over the last 2 weeks than you would have expected at the beginning of the year, as you said.
The outperformance in the US tech on the equity market versus China tech has been phenomenal. I was looking at the numbers this morning. The Nasdaq Golden Dragon Index is down 10% year to date, well off the highs, deep into a bear market. The Nasdaq 100 is up 31% over the same time period. I've been having this conversation repeatedly about US equity market exceptionalism maybe making a comeback, Sean. Where are you and the team on that at the moment?
Yeah, I think the tech story, I mean, it's a different tech story from last year, right? So you said like these consensus have been shattered this year. This consensus on tech being not the place to be. I don't think that's the same tech story we've seen last year. It's a big AI, a really exuberant story happening. I think there's something real there. It's very difficult, though, to know who's going to be the winners of that. So I think the thematic is pretty real, how it's going to play out, who's going to win, who's going to lose. And very difficult to see such a massive story, if you believe it, which is behind the rally we've seen. If you really believe that, very difficult to believe that, and at the same time not expect like massive losers from that, which hasn't been reflected yet either. So I think these thematics are real. We believe them, but I think a bit less clear about exactly where to play it out, and not convinced that the current players will necessarily be the sole winner. So something to get exposure to, but think hard about the valuations.
You're not alone. Jean Barvan there, alongside Matt Hornback. To the two of you, thank you. That's the moment we're in right now. Are we on the edge, the brink of a melt up or a meltdown? We've had that conversation a million times. Look at the equal weight S&P 500. Strip out the muscle of big tech. Month to date, we're down on the month by 3% on the equal weight S&P. Month to date on the NASDAQ, up more than 8%. We're talking about 11 points of outperformance on the NASDAQ 100, driven by some big names like NVIDIA, Meta, and it's not just those names. AMD, Salesforce, Tesla having monster years so far after difficult times through much of last year for some of those names. Going into the opening bout to close out the month of May, we're down by 0.4%. Coming up next, the morning calls, and later, Bank of America's Jill Carey-Hall joining us at the opening bout, weighing in on a weakening breadth concerns. That conversation still ahead.
So Fabien, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food, it gives us jobs, it gives us, of course, oxygen. We're taking too many fish out, we're polluting it, we're making it warmer, and only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Five minutes away from the opening bow, softer here, negative by 0.5% on the S&P 500. Likewise on the NASDAQ, down about 0.5% or so. That's the price action. Let's get to some morning calls. JP Morgan upgrading Chevron to neutral. 170 price target, saying the company is well positioned for a potential downturn. We're down 1% there. Deutsche Bank upgrading Ava's budget to buy, pointing to the stock's attractive valuation and overly negative sentiment. That stock is up by more than 4%. And finally, Credit Suisse raising its Microsoft price target to a street high 420, highlighting the company's rapid growth in AI-related products. There's another one. Microsoft 331, almost 332 in early trading, positive there by a little more than 0.1%. Coming up, stocks closing out another monthly advance despite the weakest breadth on records going back to 1990. That conversation up next with Bank of America's Jill Carey-Hall.
names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Seconds away from the opening bound this morning. Good morning to you. Negative by 0.5% on the S&P 500. On the Nasdaq, down by a similar amount. No real drama here going into the opening bound as we close out the month of May and a stellar month of gains for the big cap names in big tech. There's your opening bound. Switch at the board and get to the bond market. Yields look like this on a 10-year, down a single basis point, 367.32. More Fed speak from Loretta Mester in the Financial Times, signaling she wants to hike again in the month of June. Others will follow. Let's see what the Fed speak looks like going into the quiet period, which kicks off on Saturday. Bit of dollar strength out there, euro weakness. That euro weakness pronounced. Much more so following that economic data out of China. Disappointing. The euro 106.86. Haven't seen 108 for about a week. Euro dollar negative by 0.5%. And crude breaking lower. We're talking about multi-year lows now, potentially, on WTI in the 60s, 68 on WTI, down about 0.8% this morning. What stock to watch at the open? HP shares under pressure after reporting lower than expected 2Q revenue. The CEO saying this: the macro situation is obviously impacting demand across industries. However, we think the second half will be stronger than the first. Abby has more. Hey, Abby.
Hey, John. It's interesting because analysts seem to agree with the CEO of HP that the second half demand will recover. But in terms of the second quarter, it was disappointing. Sales came in light of what was expected. They declined 22% to $12.9 billion. The personal system segment fell 29% to $8.2 billion. That was short of the average analyst estimate of $8.4 billion. On the year, John, we do have analysts, though, echoing, again, what the CEO said, that the second half could see some sort of return to normalcy for PC demand. Morgan Stanley saying that this is the bottom. Lots of mixed messages here. On the year, this stock up about 15% right now, having its worst day since it actually might be a little bit more. I can kind of look while we're on air here, but when I last looked, the worst day since February of this year, and I think it's going to be a greater decline, which suggests that traders are weighing these results despite the fact that there could be some kind of recovery. Yes, we're looking at the worst day since August of last year, that traders are really weighing these results and not paying as much attention to the possibility of that second half recovery. We'll have to stay tuned.
Down 6%, Abby. The hope, things get better. That's always the hope. Right now on the S&P 500, negative by 0.3%. NASDAQ just a touch lighter. We're down there by 0.2%. Want to stick with earnings. Shares of Advanced Auto Parts getting hammered after missing on Q1 estimates, cutting its full-year guidance and reducing its quarterly dividend. The CEO writing, quote, "We expect the competitive dynamics we faced in the first quarter to continue, resulting in a shortfall to our 2023 expectations." Katie Greifeld has more. Hey, Casey.
Hey, John. Well, as analysts from Truist phrased it, everything that could go wrong, whatever could go wrong, did go wrong when it comes to this report. Nearly every metric was disappointing, John. Like you said, the auto parts retailer cut its earnings and sales guidance for the full year. It did reduce that quarterly dividend from $1.50 to just 25 cents. And that's all after, of course, it missed estimates for the first quarter. Like you said, CEO Tom Greco saying that the competitive dynamics that we saw in the first quarter will continue to hound Advanced Auto for the year to come. To get a little bit more specific, the company now sees full year EPS between $6 to $6.50. The previous forecast was between $10.20 to $11.20. So a big cut there. And as you would expect, the market reaction has been swift and it's been brutal. Right now, shares are off by almost 29%. As such, right now, that is the worst day ever for Advanced Auto.
Wow, Katie, thank you. A third of the market cap gone. Just like that. Let's stick with the auto sector. Tesla's Elon Musk meeting more government officials on the second day of his trip to China. Wedbush's Dan Ives saying the visit comes at a key time, writing this: playing nice in the sandbox in Beijing is something the street is laser focused on to make sure there's no disruptions to Tesla's expansion. David Welch of Bloomberg joins us right now. David, are we playing nice?
Really, Elon has to play nice in China. He's got an expansion going on, big plant in Shanghai, and he sells a lot of cars there. I think if you look at it, really, Mary Barra at General Motors has to do the same thing. So do the German car makers. They all have a big presence there. They have joint venture partners. And if you really want to grow your electric vehicle business and you want to get global scale for battery, electric motors, all that expensive stuff, you need to be able to participate in China. And the domestic players there are coming on strong, and BYD now being the #1 seller of electric vehicles in the world. So if politics cuts Tesla, General Motors, German car makers out of that market in any way, or even just diminishes their ability to sell vehicles there, that's a big problem for all of them in terms of global competition.
And David, this stock's had quite a year, up 61%. What's behind the monster gains this year relative to the difficulties we had in the previous year?
I think investors are getting used to the idea that Tesla's been cutting its prices. There seems to be a bit of stability there. I think they see Tesla having an ability to use their margin advantage to really hold off competition from the other car companies. I think last year, one of the things that hurt the shares was the fact that we had new EVs coming on from Hyundai, Kia, General Motors, Ford. And if Tesla can use a pricing advantage to still make decent profits while maintaining market share or even growing it, investors are going to like that.
David, the stock is a little bit lower this morning, down by 1%, but much, much higher on the year. David Welch there, thank you. From Tesla to Twitter, you might have seen this story yesterday that according to Fidelity, Twitter is now worth just 1/3 of the $44 billion that Elon Musk paid for the social media platform. But I think what a lot of people missed is this. Despite those issues, and because of the gains in Tesla, Elon Musk's wealth is up more than $48 billion this year. So never mind the $44 billion he paid for it last year. His wealth this year is up something like $50 billion US. Tesla is up 61% year to date, down about 1% on the session. Let's go from that to the financials. Goldman considering another wave of layoffs in what would be its third round of cuts in under a year. A representative for Goldman declined to comment. Kelly Lyons has more. Hey, Kaylee.
Yeah, John, when this news first crossed yesterday, we didn't see too much of a share price reaction. It ended the day lower by just a few tenths of 1%, but the losses are steeper this morning with the stock now down about 1 3/4%. So one of the laggards in the financial index on this Wednesday. Now, as you said, this would be the third round of cuts in less than a year. Of course, they eliminated several hundred jobs back in September of 2022. Then in January began their biggest round of layoffs ever, eliminating 3,200 positions. And now another round, we understand, according to people familiar, though it should be smaller, affecting less than 250 people. But they are expected to be more senior members of the firm. Of course, all of this happening as Goldman and banks across Wall Street are contending with a slump in deal making. That recovery has been very hard to find. It is a slump that likely will continue throughout the remainder of this year, and it has led to a reevaluation of costs. Goldman, if you recall, back in February said it does plan to reduce expenses by $1 billion, and potentially now more layoffs are going to be part of that story. Again, John, the stock down about 1.7% here in the first few minutes of trading.
Kelly, thank you. About 7 minutes into this session, more broadly on the S&P 500, we pulled back just a touch, down by 0.5%. Some relative outperformance in the Nasdaq, but still lower by 0.3%. Stocks closing in on another monthly advance thanks to the rally in big tech. The S&P 500 eyeing a third month of gains despite only 28% of the index trading higher this month. That's the worst breadth for a monthly gain on records going back to 1990. Morgan Stanley's Andrew Sliman weighing in on those bad breath concerns.
There's no conclusive proof that actually bad breath doesn't lead to always a sell-off. Many times it leads to broadening breadth in the market rally. I think that will happen. I'm just not sure, other than short term on a debt deal, I'm not sure that will happen until we get past Labor Day.
And joining us now is Bank of America's Jill Carey-Hall. Jill, wonderful to catch up with you. It's a conversation I've had with your colleague Savita, others too. I'd love your input on this subject too. Does narrow breadth matter?
Thanks for having me. You know, we've found similar to what was just mentioned in that, you know, narrow breadth and bad breadth in the market doesn't necessarily mean, you know, negative returns. You know, the better market returns have often followed periods of bad breadth. So we haven't necessarily seen that as a signal. That said, you know, the market has been led by a lot of these big mega cap tech or growth stocks. And, you know, we have a relatively benign outlook on the S&P 500 for the remainder of the year. We did get incrementally more bullish. We raised our target recently to 4,300 from 4,000. But, you know, we're more bullish on some of the areas like energy and what we'd call the old economy cyclicals rather than some of the newer growth areas. You know, we saw a sort of surprise bout of QE in the first part of the year, and that's an environment when growth stocks usually do well. But we expect more quantitative tightening rather than quantitative easing going forward. And, you know, we're equal weight tech. We would prefer tech to communication services. I think a lot of the AI spending and broader CapEx spending will benefit tech more, and it's a less crowded area. But there's still risks to tech as a cyclical sector, and you saw a lot of, you know, demand pull forward. So we're market weight the tech sector and would see leadership from some of the other cyclical areas.
Jill, let's deal with the index. As you know, year to date and month to date, we've seen massive outperformance for things like the NASDAQ versus the equal weight. The equal weight S&P 500 this month, and we've talked about this repeatedly this morning, is down by 3%. The NASDAQ is flying by more than 8%. That's 11 points of outperformance. This is kind of like historic stuff here, Jill. And if you don't have the muscle of big tech in the portfolio right now, the AI themes that you touched on, you're really not having a great year. Jill, why is this the time? And just to go back to your research, why is this the time to prefer the equal-weighted S&P 500 to the cap-weighted index?
Well, I think the equal-weighted index is, you know, much more attractively valued at this point, given the divergence that we've seen. A lot of the, you know, the cap-weighted index is much more expensive. It's, you know, more crowded in some of those areas. So, you know, better value, and you know, we do think, as I mentioned, that, you know, some of the new leadership in the market could be areas like energy, like parts of materials. You know, we could see a resilient CapEx cycle, you know, this year, even amidst a recession. So I think, you know, these are areas that could be the new leadership. The market has been hit by, you know, obviously everything going on with credit and the regional banks. Small caps have underperformed. The equal-weighted index has underperformed given the rally in tech that we've seen. But at this point, we would prefer the equal-weighted over the cap-weighted index.
You head up the strategy for small caps as well over at BofA, Jill, so perhaps we can finish there. You turned cautious back in March, I remember, off the back of some of the financial difficulties. Given the weightings towards financials in the Russell, makes perfect sense. Jill, where are you in the team now on that particular topic?
Yeah, we've still been tactically cautious on small caps. We've obviously been watching the credit backdrop and the regional banking backdrop. The small caps do obviously have more exposure to regional banks as well as to credit conditions. We have seen further tightening, obviously nothing too detrimental. Our credit stress indicators that our firm tracks are still elevated, but we're not critical. So we're watching all of these. I also think, you know, ahead of the debt ceilings, as we've seen market volatility, small caps tend to be more negatively sensitive to volatile markets. So, you know, near term, we have stayed cautious, but I think if we can see, you know, a stabilization in continued stabilization in banks and credit, and we just get this sort of mild economic recession that our economists are they're looking for, then, I do think small caps are pricing in the mild economic recession more adequately. And, if you have a longer time horizon, this could be a good entry point for small caps. We've still been bullish over the long term on small caps, relative valuations versus larger near-decade lows. And, they're going to benefit from a lot of the multi-year themes like globalization peaking, reshoring. They're bigger beneficiaries of CapEx spending. They're more domestic. So I do think for a longer time horizon, we would see better return potential there.
Hey, Jill, always appreciate your input. Jill Carey-Hill there of Bank of America. They lifted their price target recently over at BofA to 4,300, incremental, as Jill said herself. Marginal upside there on the index, on the S&P 500. The enthusiasm over at BofA on the equal weight S&P, stripping out the muscle of some of the big gainers this year, which have been the likes of NVIDIA and Meta. But that's where the gains have been. Is that where the gains will be in the second half of this year as well? About 13 minutes into the session, we pulled back by 0.3% on the S&P. On the NASDAQ, we're almost unchanged on the session. Coming up, the Fed in focus as more U.S. economic data hits the wires.
My simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause, but I do think it's possible they're going to have to raise a little bit more.
It's the final two-week stretch going into the Fed's June 14th rate decision.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies. And I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, when we look for these subprime, the reason why we shorted the subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can
connection lost.
Down. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, went from 5,000 to 45,000, I would be wiped out on the short side. So it's just too volatile to short.
News breaks. No one covers the world like Bloomberg.
A lot of the focus and the momentum here is what to do with inflation. But again, this is still a monetary policy story.
The first round results with President Recep Tayyip Erdogan showing resilience and strength on his nationalist platform.
A number of leaders have come out on both sides of the aisle and say we will not default. That does seem like they are making progress.
Bloomberg, your global business authority.
My simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause. But I do think it's possible they're going to have to raise a little bit more.
Sometimes economic data is so bad, it's good for treasuries. Yield to lower at the front end by 7 basis points on a 2-year. Mike McKee has the why. Hey, Mike.
Well, John, it's the Chicago PMI, which comes in very, very weak at 40.4, down from 48.6. The forecast was for just a small change. So that is considered bad news, but it is a tertiary indicator, and we have had some discrepancies among the regional PMIs. The real question is, what happens on a national basis? And because of the calendar, we got a very compressed week. Almost everything happening tomorrow and Friday. JOLTS comes out today, top of the hour. You'll want to stay tuned for that. That could have an impact on the market if job openings stay high. But then ISM tomorrow, we have a forecast for a very small change, but that could go down after we saw what happened with Chicago. And we'll want to see what happens in the employment index as far as ISM, but also ADP tomorrow and initial claims tomorrow. And they're all supposed to show some changes in the markets, but initial claims, we don't know the way it's been going. We do have, because of the shortened week, not much time for people to change their forecasts for payrolls. But Friday, John, we're expecting 195. We've been over the expectation for something like 8 months now. And unemployment rate, 3.5%. That would only be a tick up. And it would probably turn the conversation and the markets back to higher rates.
And Mike McKee, 3.5% unemployment does not scream recession. The data in services right now does not scream recession. But then you've got manufacturing, Mike. What is happening with manufacturing versus everything else?
Well, that's an interesting question, because usually if manufacturing is slumping, it's because people don't want to buy stuff. And maybe it's partly because they don't want to buy stuff because they're spending all their money on services. But it's a little hard to square the two things. And we won't get the ISM services number until next week, unfortunately. So we won't have that as an ingredient into jobs. But jobs and then CPI, those are going to be the big numbers that will set the Fed's course.
June 2nd, Friday, payrolls. June 13th, CPI. Mike, thank you, sir. From the data to the Fed speak, a host of Fed officials on the calendar throughout today, going into the quiet period this weekend, getting their final word in before that begins, and ahead of that June 14th rate decision. Ed Harrison joins us now. Ed, let's talk about it. Mester's talking about another hike maybe in June. Just how splintered is this committee becoming?
Yeah, I think we're at the maximum point of splintering, because you hear people like Chicago Fed President Austin Goolsbee, who wants to pause immediately. And then you hear others like Jim Bullard from St. Louis who are saying, look, we can continue going. Even Mester herself said that she would probably go for a hike. I think that Powell, he's able to get everyone on side. And I think the easiest way to get everyone on side at this particular juncture is to potentially pause as soon as possible, maybe as soon as June, and then to hold for a longer period of time. And they look like they're moving the market in that direction.
What kind of data points do you think we need to see between now and then for that to happen? Andrew Hollenhorst, the City, Ed, I think set the bar pretty low. He said 200K payrolls, 0.4% on core CPI month on month, and he said they're going to go again in June. How low or how high do you think the bar is right now?
Yeah, I think that the biggest thing probably is the labor market, as you were pointing out, payrolls. We're going to get the JOLTS data. That's going to tell us, whether or not the demand for labor is coming down. And then we're going to get as well the payrolls data. If it's over 200K, let's say 250, I think that's a really high number. We're already at about 60% chance of a 25 basis point rate hike on markets. I think you'd start to get closer to 80% at that juncture, and then the Fed would go ahead and probably hike again in June.
And maybe we'll get some dissent along the way for once. Ed, great to catch up with you, buddy. Let's catch up before we get that Fed decision. 2 weeks today, looking ahead to JOLTS. Ed talked about it. Mike talked about it. Alex Steele's going to break that down for you on Bloomberg TV in about 8 minutes' time. Your estimates at the moment, the previous number close to 9.6 million. Looking forward to that to come down to about 9.4 based on our estimates. That's the median estimate in our survey so far. So looking for that to come from 9.6 down to 9.4. You'll get the actual figure in about 7 or 8 minutes. Let's get you some sector price action. We can do that now with Abby.
We're looking at pretty bearish sector composition, John. Most sectors are lower, and we in fact have 4 sectors that are down. At the same time, we have 3 sectors that are up slightly: tech, real estate, utilities. To the downside, though, we're being led by energy, financials, materials, and industrials. Let's take a closer look at energy, because we, of course, as you've been talking about, have oil below $70 a barrel. Those China PPIs not so great, and actually that Chicago information not great either. But near year-to-date lows, down 13% on the year, John. Right now headed to its worst year since the pandemic year. Let's see whether or not those are recouped, or if oil and copper are sending signals about the economy.
Abby, thank you. Right now down by 0.4% on the broader S&P 500. Saw this market turn off the back of that Chicago PMI data, more specifically in a more pronounced way into the bond market, the very front of the yield curve on a 2-year. Now down by 7 basis points, just pulling back and retracing some of that move higher we've seen over the previous 11, 12 days. Last week, the week before that, the 2-year up big time. Month to date before today, the 2-year was up something like 44 basis points. So just chipping away at that as we go into June. We're down another 7 to about 437. Up next, your trading diary.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
26 minutes in, stocks lower. Let's get to the trading diary. Coming up very, very shortly, in about 5 minutes' time, we'll get you some economic data at the top of the hour. We'll get you the JOLTS report. Fed speak picks up this afternoon with Collins, Harker, and Jefferson. ISM manufacturing numbers, and another round of claims coming up on Thursday. Plus earnings from Macy's. That's still to come. But on Friday, it's the main event, the May payrolls report. Looking back and looking for a number that could come in close to about 200K. The estimate so far, about 195. From New York, that does it for me. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
So I think the main thing we did, which was not so easy, was to stick with our process. And then it kicked in big time in the last really 2 years.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million.
Connection lost.
It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi Number Fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's Number Fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking, the bus was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events. Asteroids is, when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.